Good morning to everyone. So the Subcommittee on Capital Markets and GSEs will come to order. Today's hearing is entitled The Impact of the Dodd-Frank Act and Basel III on the Fixed Income Market and Securitization. And to begin, of course, without objection, the Chair is authorized to declare a recess of the subcommittee at any time, and also without objection, members of the Financial Services Committee who are not members of the subcommittee may sit in on the dais and participate in today's hearing. I will now recognize myself with begin opening remarks for 3 minutes for an opening statement. So today we are here to examine the impact of Dodd-Frank, as I said, and all the rules stemming from Basel III are having on our fixed income and securitization market, and more broadly than that, begin to examine the impact that they are having on our economy and job creation in the U.S. And I thank each and every one of our many witnesses for being here today. This is one of the largest panels that we've had in a little while here at the subcommittee, so I feel bad for some of those who are maybe squeezed in the middle, in the very middle, or maybe those at the very end who can then sum up what everybody else said here. So I hope you feel well at home. I also want to thank the sponsors of the legislation that we'll be considering today for their work on some of the very important issues that we'll be discussing. As you know, nearly 5 years ago, some of us will recall that when former Fed Chairman Ed Bernanke was here, he was asked whether the Fed or any regulator had simply considered the cumulative impact of this tsunami of post-crisis rules. And you may remember his answer to that. It was one word: no. More recently, both Treasury Secretary Lew and Fed Chair Yellen have also admitted, when they asked a similar question to this committee, that despite the fact that regulators are rolling out ever more complex capital and liquidity rules, nobody has taken a moment to study how they will all work combined or in tandem with one another. So instead of a coordinated, well-thought-out legislative and regulatory approach in the wake of the financial crisis, what do we have? What we have instead is a series of ad hoc initiatives that ostensibly designed to make the financial market safer, but which in reality will only serve to put a lid on our economic potential in this country, while doing what? Sowing the seeds of the next financial crisis. As the saying goes, do not confuse motion with progress. So this misguided approach began with the Dodd-Frank Act, which was rushed through Congress on a partisan vote with little regard for what its provision would mean for Main Street America. Take, for example, the treatment of collateralized loan obligations, or CLOs. CLOs, as we all know, are vitally important to a $420 billion asset class that provides financing to Main Street businesses, which have performed extraordinarily well relative to all the other asset classes. And yet, the risk retention rules of Dodd-Frank created and treated CLOs as a highly risky asset, perhaps because of the then majority thought that anything with an acronym in it sounded risky to them. Same can be said for certain commercial mortgage-backed securities under the risk retention rules. And so I want to take a moment to thank Mr. Barr and Mr. Hill for putting together legislative solutions that would address Dodd-Frank's risk retention rules and also to help preserve these financing mechanisms for who? American businesses. Today's hearings will also examine the alphabet soup, if you will, of capital and liquidity rules stemming from Basel III and the impact that they will have on fixed income and securitization markets, both of which are vital sources of financing in this country. The prudential regulator overlords that make up the Basel Committee have made it their mission to stamp out risk in our capital markets by issuing a burdensome and extraordinarily complex series of rules. And these rules come with innocent-sounding names such as liquidity coverage ratio or net stabilized funding ratio or fundamental review of the trading book. But we know in reality these rules could have the ultimate effect of increasing risk in the banking system, cutting off services for non-financial end users, and putting American businesses at a disadvantage relative to their European counterparts. And so I look forward to our committee stepping up today and examining these issues, where the regulators have failed to do so for over these years. Again, I thank all of our witnesses and the sponsors of the bills as well, and will now yield, I believe, 5 minutes to the ranking member.
Thank you. Thank you, Mr. Chairman, for calling this hearing, and I thank all of our panelists for being here today. The U.S. bond markets are incredibly important to our economy. They allow companies of all sizes to raise capital, to expand their businesses, hire more employees, or invest in new equipment. U.S. company raised a record $1.5 trillion in the bond market in 2015. But it isn't just corporations that raise money in the bond markets. All types of loans, from mortgages to auto loans, are funded in the securitization markets. So these markets are a key part of our economy, and it is appropriate for us to review the state of these markets. However, we also need to keep in mind that the securitization markets, particularly for subprime mortgages, was a source of a lot of problems during the financial crisis. Many of the banks that were making the mortgage loans or packaging together mortgage-backed securities did not retain any of the risk for themselves, which meant that they didn't have a strong incentive to make sure that the loans were high quality and that the borrowers could afford them. Dodd-Frank addressed this problem by requiring that the sponsors of securitizations retain at least 5% of the risk on their own balance sheets. This rule, known as the risk retention rule, was intended to align the interest of the sponsors with the interest of the investors in the securitization. If the underlying loans go bad, both the sponsor and the investor will suffer. Former Chairman Barney Frank called the risk retention rule, and I quote, "the single biggest issue that we dealt with in Dodd-Frank." Two of the bills that we're considering today would codify exemptions to the risk retention rule that go beyond what the regulators determined was appropriate. One bill would broaden the exemption for commercial real estate loans from the risk retention rule, while the other would create a new exemption for securitizations of certain corporate loans. While I'm interested in hearing from our witnesses on these bills, I think we should be very careful about rolling back such an important rule, which was one of the most important aspects of Dodd-Frank, especially before the rule has even taken effect. The third bill that we're considering today is sponsored by my good friend from Massachusetts, Mr. Capuano. His bill would make a technical fix to the Volcker rule that would avoid the need for banks to rename huge numbers of funds for no good reason. The Volcker rule prohibits banks from owning hedge funds or private equity funds, and I believe this is critically important because it prevents banks from taking on the risks that come with hedge funds and private equity funds, which are not appropriate for banks. However, the Volcker rule does allow banks, under limited circumstances, to organize and offer hedge funds and private equity funds. In other words, the bank can help get the fund started, but once the fund is up and running, the bank cannot have a significant ownership stake in the fund. One condition of this exception for getting a fund started is that the bank and the fund can't share the same name or a variation of the same name. The intent of this name-sharing ban was to ensure that banks don't feel obligated for reputational reasons to bail out a fund that is initially organized. By a quirk of the way the Volcker rule was drafted, however, this name-changing ban applies not just to the bank's name, but also to any investment advisor that is affiliated with the bank, even if the investment advisor has a completely different name than the bank. It's not clear to me how this furthers the original goal of deterring banks from bailing out funds that they organized, since the fund would have a completely different name than the bank. So I look forward to the discussion of Mr. Capuano's bill and the other two bills and the testimony today. Thank you very much, and I yield back. Thank you.
I thank the gentlelady. I now yield 2 minutes to the gentleman, the Vice Chairman of the committee.
Thank you, Mr. Chairman. Our committee has heard time and time again about the unintended consequences and negative impacts on the economy of Dodd-Frank and the Basel III capital requirements. When I travel across Virginia's 5th District, I continue to hear from my constituents that Washington is making it harder, not easier, for them to do business. America's deep and liquid capital markets have a direct impact on Main Street businesses and consumers all across our country, and if Washington persists in imposing a one-size-fits-all approach, these capital markets and those who depend on them will be adversely affected. And this means less opportunity and fewer jobs for the people that we represent. While it is important to maintain a strong and robust financial system, capital requirements must take into account the complexities of different business models. The domestic securitization market has a profound impact on consumer lending, from auto loans to credit cards. If this market becomes unstable and uncompetitive, follows that many domestic market participants will be encouraged to shutter their securitization businesses and allocate capital and resources abroad. If this happens, it will impact hardworking Virginians. It's easy for unelected bureaucrats to make these decisions, but ultimately the people across Main Street America are those who feel the impact. I'm hopeful that our witnesses will be able to address some of these concerns. I appreciate the committee's focus on this issue and its continued focus on ensuring that our small businesses and startups have the ability to access the necessary capital in order to innovate, expand, and create the jobs that our local communities need. I look forward to hearing from our witnesses, and Mr. Chairman, I thank you for the time and yield back the balance.
Thank you. The gentleman yields back, all time having been consumed. We now turn to our panel. And again, thank you, all the members of the panel, for being with us today for this hearing. We'll begin with Mr. Carfang, but before we do that, just for those of you who have not been here before, so your complete record, written record will be made part, statement will be made part of the record. You will be yielded 5 minutes at this time. I always remind you to make sure that you push the button to turn on your microphone, and to the ability that you're able to, with these new microphones, make sure they are close enough to you. And of course, in front of you somewhere in those machines is a lighting indicator, green for 5, yellow, I believe, for 1 minute, and red means, well, yellow means you should be summing up, actually. And then red, it means that your time is up. Good morning, Mr. Carfang.
Thank you, Chairman Garrett, Ranking Member Maloney, and members of the committee. My name is Tony Carfang, and I'm a partner with Treasury Strategies. We're a consulting firm that specializes in treasury management, payments, and liquidity. I'm here today on behalf of our several hundred clients, businesses, state and local governments, financial institutions, hospitals, and universities who are active participants in the capital markets and rely on fixed income and securitization for their short-term capital requirements. Our American capital markets are the broadest and deepest and most robust in the world, and we applaud all of the work that's been done since the financial crisis to make them safe and to help keep them that way. Unfortunately, many of the regulations, which in isolation further specific objectives, in combination, we're now seeing as they're beginning to be implemented, are causing some toxic interaction. In some sense, and in some parts of the market, it's kind of like a high school chemistry experiment gone awry. When we put all these things in the same tube, you know, all sorts of things are happening here, and some parts of the market are being clogged and choked. Now, we applaud your efforts in considering the 3 bills that are under consideration today. And what I'd like to do is sort of set a context for what is happening in the capital markets as a result of this chemical interaction, which argues for the need for specific items of relief. Now, I'd like to say a word about risk retention. As all of our clients know, risk can neither be created nor destroyed. It can only be transformed, it can only be shifted. And to think that risk retention in and of itself will eliminate risk is kind of like thinking that car insurance will make you a better driver. It doesn't happen. It just shifts the responsibility to someone else. Now, how do we know that this chemical reaction has gone awry? Well, let me state a couple of things that we see in our consulting practice and our clients are struggling with every day. Since the regulations following the financial crisis have begun to take shape, there are 1,460 fewer banks in the United States than there were in 2010. That's a 20% decline. And that means that capital formation, particularly for small businesses and municipalities, is bottlenecked. There's less choice, there's less opportunity. In the 80 years that the FDIC has been chartering banks, in the United States, we've created about 150 new banks each and every year, going back through the 1930s. In 2010, only five new banks were chartered, and in the 5 years since 2010, a grand total of only 2 additional banks have been chartered. So we're not getting the innovation, we're not getting the robust formation at the bottom of the pyramid, which we all need. I'd like to turn our attention to money market funds in particular. Prime money market funds provide the short-term capital for businesses and for financial institutions. They buy their short-term paper. Prime money market funds are the subject of an SEC regulation designed to take in effect in October. And since the regulation was announced, 56 prime money market funds have converted to government money market funds, which means that about $264 billion that used to be lent to U.S. businesses and financial institutions are now tucked away in government securities. That money has been removed from the private economy. Now, one particular item of concern is the tax-exempt money fund market, which municipalities rely on for their infrastructure improvements, for their schools, their roads, their hospitals, college dormitories, and whatever. Since the enactment of the regulation, in my testimony when I wrote this last week, I said that 27 tax-exempt money market funds have been closed, and as a result, some municipalities and state governments will not get the financing that they need. Since then, in just 1 week, that 27 has grown to 45. And just this morning, there were announcements of closures of tax-exempt funds that specifically service Massachusetts, New York, and California municipalities. So we have a serious problem here. Mr. Chairman, you mentioned Basel III and the alphabet soup, the HQLA and all these capital requirements. What that does is it impairs the bank's ability to lend and sends investors off the grid. So in conclusion, I want to say that these regulations have stranded quite a bit of capital, and we need to put those back into the productive economy, and the 3 pieces of legislation you're considering today are a great step toward that end.
In the right direction.
Thank you very much.
Thank you. Moving next from Loan Syndications and Trading Association, Ms. Coffey, welcome to the committee. You're recognized for 5 minutes.
Great, thank you. And good morning, Chairman Garrett, Ranking Member Maloney, and members of the committee. My name is Meredith Coffey. I am EVP of Research at the LSTA, and I'm here to speak about QCLOs. Now, it's important to know the LSTA does not represent the CLO market. Instead, we represent the $4 trillion corporate loan market. Our concern here today is risk retention, how it could diminish CLOs, and how that could impact and hurt the corporate loan market. This, in turn, would hurt U.S. companies' access to credit, to the loans they need to expand, to refinance, to merge and grow and create jobs. That is why we're here today. What we would like to discuss today is, 1, how important CLOs are for lending to U.S. companies. 2, how risk retention already has impacted the CLO market. And 3, we want to voice our support for H.R. 4166, introduced by Representatives Barr and Scott. This bill offers a solution that meets both the letter and the spirit of the Dodd-Frank Act. We'll talk about why. And it will permit a safe and well-managed CLO to continue to provide financing to American companies. To start off, I'd like to discuss the non-investment grade loan market. The reality is, most American companies are not large investment-grade companies like Microsoft, McDonald's, and Walmart. The vast majority of American companies are non-investment grade. Moody's rates 2,000 companies. 70% of those are non-investment grade. Who are these? They're cable companies like Cablevision. They're airlines like Delta and American. There are food companies like Dole and Del Monte. There are restaurant chains like Wendy's, Burger King, and Dunkin' Donuts. And if you need to burn those donuts off, there are also gym companies like 24 Hour Fitness and Equinox. The reality is, CLOs provide more than $400 billion of financing to these companies and others like them. So why do folks get so concerned when they hear CLO? In large part, it's because folks assume that these must be CDOs. They are not CDOs. CLOs are not CDOs. They did not perform like them. They are not originate to distribute securitizations. CLOs are just simple and transparent portfolios of corporate loans. The proof is in the performance. Moody's calculated the 10-year impairment rate of CLOs. It was 1.5%. For CDOs, it was 45%, nearly 30 times the impairment rate on CLOs. CLOs are clearly not CDOs. Unfortunately, risk retention will do great damage to CLOs and to the companies that rely upon them. Last week, Moody's issued a report on companies' needs to refinance and noted that CLOs will meet a smaller portion of corporate refunding needs due in part to risk retention. In fact, risk retention already is affecting CLOs. Starting in the second half of 2015, last year, investors began requiring CLOs to be risk retention compliant or at least have a detailed plan to comply. Why? Because the investors required CLOs to show they had the ability to refinance, or at least show the fact that they would exist in 2 years. The result? CLO formation dropped 20% last year. Second half 2015 CLO formation was down 40% from first half levels. And risk retention is already picking winners and losers. 30 smaller managers that issued CLOs in 2014 could not do so in 2015, largely due to risk retention. This is not just a CLO problem. It will impact a number of companies' ability to refinance their debt. Moody's said non-investment grade companies have more than $700 billion of debt coming due in upcoming years. Bloomberg reported that Fed officials have begun to worry about credit availability, and regulators themselves have said risk retention will reduce the supply of credit. So what will happen? If U.S. companies cannot refinance their debt because CLOs are not there for them, companies either will have to pay up substantially to entities like hedge funds, or worse, they may not find credit, and this could lead to downsizing, job cuts, and, worst case, possible bankruptcies. But this scenario does not need to happen. Instead of curtailing the CLO market, we ask the committee to consider and pass 4166, which contains a sensible alternative, the QCLO. How does this work? A CLO would have to meet requirements in 6 areas: asset quality, portfolio diversification, capital structure, alignment of interest, regulation of the manager, and enhanced transparency and disclosure. If a CLO does this, then the manager can purchase and retain 5% of the equity, which, critically, along with the subordination of its fees, would absolutely meet the 5% risk retention requirement in Dodd-Frank. Thus, the QCLO not only requires 5% credit risk retention, but it also adds quality restrictions into the mix. Thank you very much for your time. I look forward to any questions you may have.
Thank you very much for that. Mr. Green, welcome to the panel, and you're recognized for 5 minutes.
Thank you, Chairman Garrett and Ranking Member Maloney, for the opportunity to testify on this important topic. I'm Andy Green, Managing Director of Economic Policy for the Center of American Progress, and I'd like to make 5 points today. First is that fixed income markets are better thanks to Dodd-Frank and Basel III. Second, reforms reduce what Paul Volcker calls the liquidity illusion, helping to protect us from bubbles and bailouts. 3, transparency in the fixed income markets should be increased. 4, Congress and regulators should be proud of the changes put in place and finish the job. And lastly, the bills today being considered by the subcommittee are unwise and unnecessary and should not be adopted. First, fixed income markets are better. For months, the financial industry has warned of a so-called liquidity crisis following the implementation of new and supposedly burdensome regulations. The argument goes as follows. Basel III capital charges and the Volcker Rule limits on risk-taking and holding positions are killing dealer inventories. Without inventories, clients won't be able to trade. Spreads will widen and costs of financing will go up. The real economy will be harmed. But as Paul Volcker and others have long known, reality is entirely the opposite. Don't take my word for it or even his. The New York Fed, of all places, and FINRA, the broker-dealer self-regulatory organization, have all concluded that liquidity as good or better than pre-crisis levels. Here's the data. Primary issuance of corporate bonds is above pre-crisis levels. A record $1.5 trillion was issued in 2015 compared to approximately $750 billion in 2005. Borrowing costs are at or near all-time lows. Overall, even asset-backed securitization issues also look similar to the levels that existed in 2000-2004, although this varies by particular market. Indeed, a major concern among economists has been an overheating of credit markets. Second, in most key respects, the trading market continues to perform very well. Bid-ask spreads in corporate bond markets are 10 to 25% tighter compared to the lows prior to the crisis. The price impact of trading blocks, another good measure of trading costs and liquidity, are actually as good or better than 2005, some of the lowest points of the pre-crisis period. Certainly trade sizes are down somewhat, as is turnover. This is not clearly good or bad. Other market structure factors such as rising automation and increased ETF trading or greater concentration on the buy and the sell sides may be at play. Notably, we do not see price impacts. In short, to sum up in the words of New York Fed President Bill Dudley, quote, there is limited evidence pointing to a reduction in the average levels of liquidity, unquote. So, some have expressed concern regarding what might happen when markets hit the next air patch. The hypothesis goes that a liquidity crisis will result. But this is largely mistaken. Dealers do not catch the falling knife. Instead, they respond to similar incentives, motivating other investors to sell. Secondly, it's important not to confuse trading volumes with liquidity. Liquidity is not a price guarantee. High volumes, in fact, can lull market participants into believing they can get out at any time, at any quantity, at any market circumstance, without observing any price change. This is what Paul Volcker calls a liquidity illusion. Not only is this dangerous because it diminishes investor responsibility and harms the ability for the capital markets to efficiently allocate resources to the real economy. The changes put in place since the Dodd-Frank have made us safer. So what should we do? We should do several things. We should be increasing transparency. Just as we did just as the introduction of the trace reporting system in 2002 brought trading costs down significantly, enhanced reporting in the treasury markets, in tri-party and bilateral repo markets, relating to investor costs, as folks like Commissioners Pivovar and Commissioner Stein of the SEC have all urged. These can make significant improvements. In particular, we also need to move faster to modernize financial industry disclosures. It's important that we finish the job. The stronger performance of the U.S. banking sector compared to the European banking sector demonstrates the importance and value of U.S. reforms. The movie The Big Short reminds us of the importance of the provisions of Dodd-Frank that banned the very conflict-ridden practices that corrupted our securities market. The SEC needs to finish them immediately. And it needs to finish the job on implementing CDS infrastructure swap market reforms. I would also urge the committee not to adopt the bills under consideration today. They are overbroad, unwise, and unnecessary. In short, what we simply need to do is move forward with compliance, as Paul Volcker has said, for the good of the country. Thank you very much, and I'd be happy to answer any questions.
Thank you very much. Mr. Johns, welcome to the panel as well, and you two are recognized now for 5 minutes.
Chairman Garrett, Ranking Member Maloney, and members of the subcommittee. My name is Richard Johns, and I'm the Executive Director of the Structured Finance Industry Group. Prior to SFIG, I spent over 22 years in the finance industry, including as head of global capital markets at Capital One, responsible for all fixed income funding before and during the financial crisis, and as global head of funding and liquidity at Ally Financial after the crisis. Today, I'm testifying on behalf of the 350 institutional members representing all areas of the securitization industry, including investors and issuers. I'll testify to a number of global regulatory issues that affect lending across asset classes, including the definition of high-quality liquid assets under the joint agency's liquidity coverage ratio, international efforts to create a high-quality securitization definition, Basel capital rules, and the fundamental review of a trading book. Beginning with the LCR, we believe the new LCR rules are misguided in several areas. First, the LCR does not treat any class of asset-backed securities as high-quality liquid assets, essentially branding all ABS as illiquid. This blanket exclusion is unwarranted. High-quality ABS are among the most liquid assets that a bank can hold. Before, during, and after the credit crisis, credit card and auto ABS largely retained market access and performed better than investment-grade corporate debt, which was granted HQLA status. Second, the implementation of various Dodd-Frank requirements have created significant changes in practice across the entire securitization industry. If these changes are deemed to have any value at all, then how can an ABS security previously deemed to have zero liquidity still be deemed to have zero liquidity after the implementation of Dodd-Frank? Effectively, we're being told by our regulators that 0 plus something equals 0. In Europe, a less liquid market than the US, policymakers are actively recalibrating this potential overregulation and have identified high-quality criteria for asset classes that they believe warrant preferential capital treatment. This concept has been extended to global securitization through a similar initiative undertaken by Basel and IOSCO. However, while the rest of the world moves forward, US regulators have shown no interest in following a similar course. If this continues unchecked, then European investors will receive capital relief on local collateral and will be incentivized to invest locally, leaving a risk of market fragmentation, thereby reducing market liquidity. If other countries implement IOSCO Basel criteria, then all global investors except US investors will receive preferential capital treatment, creating a risk of over-reliance on non-US funding in our capital markets and consequently our economy. Compound that with recent developments of Basel's fundamental review of a trading book, which sets capital standards for broker-dealer inventory. A major driver behind US marketplace rebounding more quickly from the credit crisis was the crucial role of the market maker, a role that simply isn't replicated by any other country's capital markets. They did catch the falling knife. Without bid offer levels and inventory capabilities, investors would not feel confident the securities they buy will also be able to be sold. Early indications suggest that capital may increase by up to 50%, causing market making to become uneconomical and broker-dealers to potentially exit the market. Investors are already concerned that this may cause illiquidity. These unjustified increases in capital follow perhaps the largest example of redundant capital created when the FAS 166-167 accounting standards forced issuers to hold reserves against losses despite the contractual transfer of risk of loss to investors. Despite the fact that we know investors took losses during the credit crisis, issuers are still required to hold reserves against every dollar of risk transferred. Layering the fact that banks must also hold 10% regulatory capital against that same risk creates a duplication and redundancy of capital that, if corrected, could generate tens of billions of dollars in lending to consumers and businesses in your districts. Therefore, we recommend the following actions. Require US regulators to examine the combined effects of regulations on ABS liquidity. Require US regulators to work with international regulators to develop a globally consistent standard for high-quality securitization. Designate high-quality ABS and MBS as HQLA under the final LCR rules. Re-examine loan loss reserve accounting to ensure that reserves are only being held against actual contractual obligations. And finally, support HR 4166, which our members, issuers and investors alike, believe creates a workable option for CLO risk retention. Thank you for the opportunity to testify, and I look forward to your questions.
And I thank you for your testimony. Dr. Stanley, welcome to the committee, and you are now recognized for 5 minutes.
Thank you, Chairman Garrett, Ranking Member Maloney, and members of the subcommittee. My name is Marcus Stanley, and I'm the Policy Director of Americans for Financial Reform. The issues examined by the committee today, including securitization market, activities in bank trading books, and liquidity, go to the very heart of the 2008 financial crisis. Indeed, a shorthand description of that crisis might read, irresponsible practices in securitization markets infected the trading books of key dealer banks, leading to a catastrophic failure of market liquidity. It is therefore not surprising that the Dodd-Frank Act targeted these areas for reform. Now, some are calling these reforms into question because of their supposed impacts on market liquidity. We oppose these efforts to roll back post-crisis reforms. It is particularly ironic that they are being advanced in the name of increasing liquidity. A central lesson of the 2008 crisis is that market liquidity can be excessive, the liquidity illusion that Mr. Green referred to, and that such excessive liquidity leads to disastrous market crashes that have far more damaging liquidity effects than any that might be created by prudent limits on excessive leverage and risk-taking in normal times. Indeed, the financial crisis led most securitization markets to essentially shut down to new issuance for a period of years, an impact that dwarfs any marginal effect on such markets that could emerge from Dodd-Frank reforms designed to improve securitization quality. There has been a great deal of speculation about changes in liquidity due to regulation, but very little hard evidence. Quantitative analyses have not found changes in liquidity that appear economically meaningful. Indeed, where such changes are seen, they often appear positive, such as compression in spreads. There does appear to have been some decline in average trade size, but changes in trade size do not appear to have had an impact on investor costs, and any impact on systemic risk is at this point extremely hypothetical. There has also been some increase in the frequency of brief but disruptive flash crashes. These are probably due to the growth in high-frequency algorithmic electronic trading, rather than to new financial regulations. Regulators should address the risks of such electronic trading as a separate matter. Any changes in fixed income market liquidity also do not appear to have blocked the access of real economy firms or public borrowers to funding. Bond issuance over the past few years has soared to levels well in excess of pre-crisis highs. And returns to municipal bonds, in other words, the costs of borrowing for municipalities, are at 50-year lows. Two bills before the committee today would fatally weaken Dodd-Frank risk retention rules designed to improve asset quality in securitization markets. These bills go far beyond the sensible underwriting-based exemptions that regulators have already placed in their final risk retention requirements. H.R. 4166 and the CMBS discussion draft would enormously increase the scope of exemptions and prevent regulators from applying reasonable underwriting standards. For example, H.R. 4166 apparently completely eliminates any controls on leverage of the borrowing company receiving a commercial loan as a requirement for CLO risk retention. The CMBS discussion draft exempts interest-only loans from risk retention requirements and provides a blanket exemption for all single loan securitizations regardless of underwriting quality. We urge the committee to reject this legislation and to preserve the positive incentives created by risk retention, which would be fatally undermined by the overbroad exemptions in these bills. As laid out in my written testimony, AFR also has some concerns with H.R. 4096 on Volcker Rule naming restrictions. As the bill is currently drafted, it seems to leave open some possibilities for naming practices that could create an inappropriate inference of sponsorship. We would oppose the bill as currently drafted, but are open to working with the sponsors on potential changes to the bill. My written testimony also discusses the importance of other reforms, such as the fundamental review of the trading book. The fundamental review of the trading book is directly aimed at issues revealed by the financial crisis that permitted banks to borrow excessively against assets in their trading books. I would like to close with a piece of good news. Yesterday, the FDIC announced that over 95% of American community banks were profitable from the year 2015, over the year 2015. This is up from just 78% in 2010, the year that the Dodd-Frank Act was passed. This is just one example of what I believe are many positive elements of our financial markets that have occurred under Dodd-Frank. Thank you, and I look forward to taking questions.
Great. Mr. Plunkett, welcome to the panel, and you are recognized now for 5 minutes.
Thank you, Chairman Garrett, Ranking Member Maloney, members of the subcommittee. My name is Jeff Plunkett. I'm General Counsel of Natixis Global Asset Management. We are a wholly owned subsidiary of Natixis, a French bank that operates a single branch office in New York and does not accept FDIC-insured deposits. Natixis and each of its affiliates, including each investment manager affiliated with us, is, however, considered a banking entity under the Volcker Rule. Asset managers play an important role in the global financial system. Through our clients' funds, we provide an important source of capital formation and liquidity to markets worldwide. We serve individual investors' retirement planning by managing pension, 401k, mutual fund, and personal investments. Innovative asset managers provide new products that help individuals save for retirement. Asset managers affiliated with banks also contribute a source of revenues that is not dependent on the capital of the parent bank. Each of our managers operates under its own historical name and branding, and with only a couple of exceptions, none has Natixis as part of its name or logo. Each of our U.S. managers is also separately registered with and regulated by the SEC. Under the Volcker Rule, I'm pleased to be here today and have this opportunity to discuss H.R. 4096, the Investor Clarity and Bank Parity Act. H.R. 4096 would make a very limited modification to the Volcker Rule. The Volcker Rule, as noted by Ranking Member Maloney, restricts the ability of banks and investment managers affiliated with banks to sponsor hedge funds and private equity funds. Investors in these funds are principally sophisticated institutions such as pension funds that are trying to diversify their investments and manage risk. The Volcker Rule permits a banking entity to offer private funds subject to certain conditions. one of which is that the fund may not share the same name or a variation of the name with the banking entity that is managing the investments. Unfortunately, this provision is at odds with both industry practice and the goal of providing clarity to investors about who is managing a fund. In our experience, most private funds contain the name or a variation of the name of the investment manager. Thus, a fund managed by ABC Investment Manager might be called the ABC Private Fund. This clearly distinguishes this private fund from other funds managed by other investment managers. This practice has been in place for many years, and in our experience, investors in private funds prefer to see the name of the fund manager in the name of the fund. Under the Volcker Rule, our managers and other bank-affiliated asset managers are now prohibited from using their name to identify their own private funds. This puts them at odds with investors' desire for clarity and at a competitive disadvantage with independent asset managers. The situation is even more illogical when the bank-affiliated managers have a name that is totally different from their parent bank, as we and certain others do. The primary purpose of the name-sharing prohibition is to prevent investor confusion about who ultimately bears the risk of loss. However, this risk is already addressed in a number of ways in the Volcker Rule, which requires that the banking entity not guarantee the performance of the fund, disclose clearly to investors that losses are borne solely by the investors and not by the banking entity, and clearly disclose that ownership interests in the fund are not insured by the FDIC. These restrictions are more than sufficient to ensure that funds sponsored by a banking entity are understood by investors to be separate from their sponsor and their affiliated bank. It's simply a quirk in the Volcker Rule that this applies to separately branded investment managers. We support H.R. 4096 because congressional action is the only option to change the name-sharing prohibition. The prohibition was one of the most heavily commented upon aspects of the Volcker Rule during its drafting, but the regulators concluded that the legislation was clear and adopted the restriction as proposed. The regulators appreciated our belief that the Volcker Rule was not intended to affect the naming of funds where the investment manager's name did not link the manager to its parent bank. They said that the text of the Volcker Rule did not leave room for regulatory interpretation. H.R. 4096 is a narrowly tailored piece of legislation that is a limited technical amendment and can provide the necessary relief without undermining the intent of the Volcker Rule. Mr. Chairman, we urge Congress to support, to adopt H.R. 4096. Thank you very much. Be happy to take questions.
Thank you, sir. Last but not least, at the end of the day, Mr. Rennick, thank you for being with the panel, and you're recognized for 5 minutes.
Thank you, Chairman Garrett, Ranking Member Maloney. The Commercial Real Estate Finance Council, known as CREFC, is the trade association for the $3.5 trillion commercial real estate finance industry. Its 300-member companies include lenders of all types, balance sheet and securitized, as well as investors and servicing firms. I am CREFC's president and CEO. My testimony today will focus on the commercial mortgage-backed securities, or CMBS, side of the commercial real estate finance industry. This is the sector most affected by regulations. I do want to note that CMBS is completely distinct from residential mortgage-backed securities. Mrs. Maloney referred to RMBS and the subprime loans that are well known to have been within that and the problems they created. Under RMBS, mortgages are underwritten at the borrower level. For CMBS, mortgages are underwritten at the asset level. CMBS is about 25% of all commercial real estate lending, about $100 billion per year. It expands the pool of available loan capital beyond what balance sheet lenders, banks, and insurance companies can contribute to meet borrower demand. There is $600 billion of outstanding CMBS debt, $200 billion of which will need to be refinanced in the next 2 years. Many of the borrowers are in secondary and tertiary markets. CMBS financing may be the only, or at least the most cost-effective financing they can get. By providing access to the public capital markets, CMBS allows banks and other mortgage originators to free up their balance sheets so they can recycle their limited capital into new loans. It is efficient and deconcentrates risk that could otherwise overweight the balance sheets of banks, as we saw during the Great Recession. Several regulatory agencies have been tasked with working collaboratively on Dodd-Frank rulemaking. With such a daunting task, it is no surprise that many aspects of the rules apply broadly across asset types and lack specific correlation to the varying characteristics of different types of assets and industry sectors, such as CMBS. The problem is one size does not fit all. To date, CMBS is subject to Reg AB, Basel III, and of course Dodd-Frank risk retention and others. The sheer number of rules and their breadth is contributing to retrenchment by banks and illiquidity in the markets. In many cases, the regulatory burden outweighs the prudential benefit the regulators are trying to achieve. Regulation is institutionalizing inefficiencies. Today, CMBS investors are demanding return premiums similar to corporate junk bonds, yet property fundamentals are strong. Property owners face the prospect of higher rates on loans, tougher credit, and diminished property values as debt issuance slows. Estimates for this year's CMBS issuance have been downgraded from over $100 billion to $70 billion. The market is becoming fragile even before half of the planned regulations come into effect. Illiquidity and volatility are becoming the norm. Why is the CMBS market suffering dysfunction? Well, there are many macro external factors disrupting the capital markets. But it's also clear that regulation has a role too, and a big one. Regulators have concluded that securitized loans are more risky than loans kept on balance sheet, regardless of underwriting, credit, or capital. The regulatory cost of capital they impose is simply based on the lending platform. This is a flawed premise. Because of this burden, CMBS is losing institutional capacity. Banks and mortgage originators are leaving or substantially reducing their commitment to the market. Once industry capacity shuts down, it takes a long time before it returns. We saw that after the crisis in 2007. Loss of capacity is problematic in the short run and dire in the long run. When we get to the point in the cycle where capital and credit get scarce, and we will, then the loss of CMBS capacity will hit borrowers broadly and hard. Additionally, CMBS bond investors typically are pension funds and insurance companies. What hurts CMBS hurts pensioners and life insurance beneficiaries. We urge Congress to provide modest relief from the risk retention rules for one sector of CMBS known as the single asset, single borrower market. This is embodied in Congressman Hill's discussion draft, which we urge the committee to support. Single asset, single borrower is a securitization of a single large mortgage on one asset, such as a mall, hotel, or office building. Financing of these large, high-cost assets is often beyond the scope of one lender. Therefore, it's more efficient to use CMBS and therefore access the public capital markets. Investors invest enthusiastically in single asset, single borrower securitizations because the assets perform extremely well and are easy to analyze and underwrite. This is not a multi-mortgage conduit transaction. The idea of risk retention was to protect investors buying securitizations where you had dozens of assets in a pool and it was hard for investors to analyze what they were buying. Nevertheless, regulators with a broad brush applied risk retention to single asset, single borrower. This lacks rationale and will do more harm than good. Not only does this add cost to borrowers and reduce yield to investors, it hampers the effectiveness of single asset, single borrower. We urge the committee to support Mr. Hill's discussion draft.
I thank the gentleman. So at this point now I'll turn to questioning. And I'll recognize myself for 5 minutes. So a great discussion, a great panel. Appreciate it very much. Get into the weeds on a fairly complicated topic here. Let me bring it down to some simple point of view as I look at it. A, was there a problem to begin with? And B, is whether the solution of Dodd-Frank has caused any additional problems going along. So the seminal question was, and there seems to be some different views about this, about the performance of certain asset classes during the last decade, and particularly the years leading up to and around the financial crisis. I'll throw it to Mr. Johns first and say, in a nutshell, how did highly rated assets-backed securities perform during the financial crisis relative to everything else out there, in a nutshell? And then I'll go to Ms. Coffey. Microphone.
During the financial crisis, so I was at Capital One, we had obviously an auto and a card platform. What I would say is, during the crisis, the loss performance performed very much in line with expectations. If you're looking at prime auto, prime credit card, losses tracked unemployment up to a certain point in card space. Losses in auto stayed, relatively low. I would say prime auto generally less than 2%.
So, well, let me just throw over, I guess, a bunch more questions. Ms. Coffey as well. Did the CLO market perform relative to other asset classes? You touched upon this before, but I just want to drive home.
Absolutely. CLOs performed extraordinarily well. In their 20-year history, the cumulative impairment rate for CLOs was 1.5%. That 20-year history includes the financial crisis. CDOs, 45%. Okay. Very different performance.
So this jives in with what Mr. Johns is saying here as well. So we didn't really see although there was a point by Dr. Stanley talking about excessive liquidity, and I know you made reference to excessive liquidity leading to potentiality for excessive leverage. But when I was listening to that, there's a saying, I had to remember what it is. Causation is not always correlation. And the gentleman from Maine is not here, but I heard a study once in the state of Maine where it said that there's an uptick in the divorce rate in the state, and at the same time there was an uptick in the use of margarine. Now, you couldn't say the case that there was a causation by people using more margarine that was the causation of the increase in divorce rates. I would just say that there was not a causation, that maybe it's just a correlation. So can anyone else address the issue? Is there a correlation? Is there a problem with, Mr. Renna, for example, is there a problem necessarily with a lot of liquidity in the marketplace?
Well, first, Chairman Garrett, to your question about was there a problem before, the CMBS industry needed to address some issues within it, and it did. But I will say that bonds that were issued before the crisis, on AAA bonds, there are no losses on those AAA bonds. And single asset, single borrower securitizations had absolutely no
So I guess
losses.
the answer to the question is even though you had a lot of liquidity during that period lead up into that time, you did not see a problem. So let's go to the second case. So now we didn't see a problem, but we had Dodd-Frank that have all these regulations in there. The next question is, hey, is Dodd-Frank causing a problem? We've heard a couple of people say, no, there's no problem in this marketplace. But that doesn't comport with what we heard from a couple other people. The chair of the Fed. The chair of the Fed came here in March and acknowledged in testimony before this question, quote, there's no question that there are concerns about the liquidity, quote, in the fixed income market. After her, we heard from Richard Ketchum from FINRA, who said that, quote, there's been dramatic changes with respect to the fixed income market in recent years. Many of them come in reaction to the failures and the market impact coming out of the crisis. This led to much higher capital requirements, Volcker rules, and he just goes on to agree basically more emphatically with Chair White. Mr. Carfang, I only have a few minutes. Can you say this in your testimony? The combination of the Volcker rule and increased capital requirements results in financial institutions scaling back their market-making activities. This results in wider bid-ask spreads, and ultimately, too, less liquidity in the market. Is that true, what you said there?
Yeah, absolutely, sir. In terms of putting this in context, the macro statistics belie what's actually happening in the economy. Yes, there are $1.5 trillion of new loans, but they are going only to the largest and most creditworthy borrowers and not the mainstream businesses or municipalities.
And is it true also, as you said, that there have been sporadic liquidity black holes in which when the markets completely freeze up or prices gyrate widely since that time?
Absolutely. We had the U.S. Treasury flash crash about a year ago and several other pockets where securities could not be sold at any price, albeit for short periods of time, but liquidity means, it's there when you need it.
Sounds like a problem to me. Thank you. Thank the panel. At this time, I yield to the ranking member from New York.
Thank you very much. Mr. Green, some of the witnesses here today have argued that the risk retention rule will raise the cost of credit and therefore should be rolled back. Didn't the regulators estimate that the risk retention rule would raise the cost of credit modestly, but decide that these costs were worth the benefits that the rule will provide? For example, the Fed estimated that the rule would raise the cost of a certain commercial mortgage-backed securities by at most 0.25%, but they determined that the benefits better quality loans and fewer defaults would far outweigh the costs. Do you think the regulators were sensitive to the potential impact that the risk retention rule would have on cost of credit when they were writing the rule? And in your opinion, will the benefits of the rule outweigh the cost? I'd like your comments and also Dr. Stanley's.
Thank you very much, Ranking Member Maloney. Absolutely. There's hundreds of pages of economic analysis that went along with the rule, carefully analyzed, carefully studied, and absolutely the benefits far outweigh the costs. These are common sense solutions. We saw the terrible originate to distribute model that was it was because there was not real risk retention that was transparently priced up front at the beginning of the transaction. Risk retention really is just a transparency tool to make sure that the real risks of the loans are being repriced. And to the point about the concerns that the chairman noted earlier from Chair White and Ketchum, really what we've been seeing out there is that the data has shown the complete opposite. We are far more secure. The costs of illiquidity from the financial crisis far outweighed any of the changes that are being brought about today.
Okay, thank you. Dr. Stanley, would you agree?
Absolutely. I think that this goes to this issue of excessive liquidity and its connection with financial risk. The financial system is healthiest when risks are properly priced, which can sometimes mean that something is priced higher because people have the correct expectations about the potential market risk and credit risks that they're taking. And one thing that we learned in the financial crisis is it's very clear that when people are set up to think that they're making investments that have very low risks, and they suddenly decide that these risks are much higher than they thought, that market chaos ensues, that we can see absolute shutdowns of markets. And Mr. Johns mentioned that some of these securitizations in the long run performed well in terms of people paying back their loans and so on. Well, that wasn't understood at the time, and in fact, their market prices dropped very significantly during the crisis, not just in mortgage-backed securities, but in many other areas of securitizations as well. And that's why we saw shutdowns in these securitization markets for such a long period.
But what you're
Thank
referencing
you.
there is an issue of transparency.
Thank you. And my question now is to Mr. Plunkett. I have very limited time. You noted in your testimony that investors in hedge funds and private equity funds are typically sophisticated professional investors, and I personally think that's very important. Do you think that sophisticated investors in a fund would already know who initially organized the fund, even if the fund had a completely different name?
Thank you. Yes, the institutional investors will know as part of their diligence process. HR 4096 is just trying to promote transparency and make it easier for everybody to understand which manager is managing which fund.
And would you say, in your experience, does having a fund you organized share a name with your investment advisor really hold your feet to the fire?
Our managers, and throughout the asset management industry, our managers try very hard to protect the interests of their clients. No matter what happens, the VOCA rule prohibits, in any event, bailing out or guaranteeing funds. So the name sharing really doesn't change that. They are prohibitions, you'd say, in Dodd-Frank now that would pertain to your inability to bail out a fund. In other words, could you bail out a fund under Dodd-Frank even if you wanted to? You're prohibited from doing so, aren't you? Yes, we are.
Okay. And Mr. Green, some Republicans on this committee have argued that stronger regulation of the banking industry, and particularly the VOCA rule, are harming the liquidity in our fixed income markets. Do you agree with that statement? What's your response to that?
Yeah, it's just absolutely, the data has proven, the New York Fed has extensively studied. The New York Fed, very close to Wall Street in terms of information, has absolutely concluded the data is not there. We see record high corporate issuances, record low costs of capital, and bid-ask spreads and price impact for even large block trades is tighter than ever.
Okay, thank you very much. My time has expired.
Thank the gentlelady. Gentleman from Virginia is recognized for 5 minutes.
Thank you, Mr. Chairman. I wanted to follow up on the chairman's line of questioning, specifically as it relates to the corporate bond market and the impact that post-crisis regulations, Dodd-Frank, et cetera, have had in what many are very concerned about, and Mr. Green has talked about that specifically. And I think it's interesting also that we've had certainly witnesses who've testified before this committee that have just said basically nothing to see here, let's move on when it comes to this concern. And so I wanted to ask Mr. Carfang first, and sort of following up more particularly about the corporate bond market and the liquidity concerns there. And if you could respond, directly to what Mr. Green has laid out in terms of whether or not we should be concerned about this liquidity, and as it specifically as it relates to the things that you have laid out in your testimony that suggest otherwise. And then I would like to hear from Mr. Plunkett on this as well when you're finished.
Sure. Mr. Green's facts are correct. His conclusions are wrong. We have a.
Can you explain that more?
We have a Federal Reserve that has inflated its own balance sheet from $1 trillion to $4 trillion over the course of the financial crisis. That completely disrupts the financial markets in a way that reduces interest rates. So when Mr. Green says borrowing costs are an all-time low, well, yes, but that's Fed-induced, not market-induced. When the Fed unwinds its balance sheet, frankly, no one knows. That's going to be another chemical put into the experiment. Our clients, particularly those who are not of the highest credit rating, are having difficulty raising cash or raising cash at rates that make sense for them to create jobs and expand their businesses. That's true for our corporate clients. That's true for municipalities and state governments as well.
Do you think that if the Federal Reserve raises rates in the future, that will exacerbate this problem? And where does systemic risk fit into all of this?
Well, I'm not sure that it will exacerbate the problem. I think if the Fed allows rates to settle where they would naturally settle in the marketplace, we would have the most optimal results.
Okay, Mr. Plunkett, love to get your thoughts on this.
I'm not prepared to speak in any detail on this subject, but we do hear from our asset management firms that the liquidity in the fixed income market has certainly changed. Not for the better. The one point I might add is that when we talk about the amount of corporate bond issuances, it might be linked to the fact that investors are searching for yield, and it's a zero interest rate environment. So, companies are certainly going to go out and tap that zero interest rate environment as much as they can.
Excellent.
One thing I might just sort of add to the
Mr. Johns, yeah, please.
I don't know if the corporate bond market is the right place to have our focus here. If we're looking at the impacts of Basel, that's not the corporate bond market. You need to be looking at the financial industry, the securitization industry, and anything that is impacted from a banking regulation perspective. I could be a pharmaceutical company issuing corporate bonds. I don't know how Dodd-Frank and how Basel regulations necessarily going to impact that. So it may be true that there's more issuance in corporate bond space, and that may ultimately create some element of corporations being able to fund themselves. But if you're looking at the main mechanism of delivering funding to the real economy, look to the financial sector, which is not necessarily the same thing as the corporate bond market.
Mr. Renna or Ms. Coffey, do you all have anything to add?
The one thing I would add to that is we're talking about interest rates being at all-time lows for companies. It's important to remember interest rates are comprised of two components, the base rate, the treasury rate, or LIBOR, which Fed monetary policy has reduced very substantially, and it's also composed of the spread. The spread over those base rates is extraordinarily high right now, and that is something that we do need to bear in mind.
Okay, thank you. Mr. Chairman, I yield back my time.
The gentleman yields back. Ms. Hinojosa, I believe, is next for 5 minutes.
Thank you, Chairman Garrett and Ranking Member Maloney, for holding this timely hearing. I also wish to thank our distinguished panel of witnesses for their appearance and testimony today. Although more than 7 years have passed, the height of the financial crisis, we continue to feel its aftershocks reverberating through our economy and financial system. We have seen troubling episodes of increased volatility and less liquidity in our markets. So as we examine the health of our capital markets, we should take a good look at not only the possibility of intended consequences of regulations, but also look at how the fundamental structure of our markets have changed. A myriad of factors are contributing to this volatility, and we should be wary of claims that regulations are the one and only cause, or that they are not having any effect. Moving forward, we need to ensure that our legislative efforts provide for a vibrant market without undermining the safety and soundness of our financial system. My first question is to Mr. Stanley. According to the bond market liquidity reports issued quarterly by the Fed, the FDIC, the OCC, the CFTC, and SEC, liquidity in both primary and secondary markets remains strong. However, we have had several episodes of market volatility and signs that the market depth has shallowed in the bond market. Do you think our bond markets are healthy and would remain resilient in the face of market stress? If so, please explain.
Well, there are these concerns, as you say, that, and this relates to this issue of smaller trade sizes that I mentioned, that the higher capital ratios on the big dealers have made markets shallower. I think that at this point, these concerns are very hypothetical. I don't think that they have been proved out in terms of anything that's actually been seen in the financial markets. It's the regulator's job to worry about these possibilities in the future. I think that the gains that we get by ensuring that the major dealers are at the center of the system, are well capitalized and don't borrow excessively, are much greater than any potential slight increase in spreads that could occur from shallower markets. One thing that we saw in the crisis clearly was that when those dealers are over-leveraged and when they are impacted, when they have to engage in fire sales when prices drop, that the negative impacts are just absolutely enormous, and it's crucial to protect against that.
If that's so, have the regulatory changes made by Dodd-Frank negatively impacted the bond market liquidity?
I don't believe that they have. People point to a drop in bond market inventories at the major dealers as somehow being problematic. But as I say, I think that these make these dealers, first of all, I think that those changes emerged coming out of the crisis. They predate Dodd-Frank. And I think that to the degree that those changes are because the major dealers actually have to hold real capital against their balance sheets as opposed to borrowing, I think they make the markets more stable and durable.
That's not something that we've seen evidenced by the market. I would say that, at crisis and immediately post-crisis, you might have had a dozen dealers that had capacity to take maybe $1 billion down onto their balance sheet. Now, maybe that number is 3. You're seeing inventory go down. I think, Steve and Meredith, I'm sort of asking you to sort of comment on this. RMBS, CMBS dealer inventory is down about 50% in the last 2 years. So we're seeing something. This is not hypothetical.
Let me hear from Mr. Green. In your testimony, you mentioned that the electronification of the bond markets in the past have been dominated by the large bank dealers, and that is changing the characteristics of those markets. To what extent did Dodd-Frank and Basel capital requirements interplay with the increasing effects of the markets?
So I think that there are important technological changes going on in the markets. We are seeing increased electronification, especially in the treasury markets. That is a function of change in technology, and frankly is not a function of regulation. And frankly, it's something that folks on both sides of the aisle have seen offers potential for good. Folks like former SEC Commissioner Dan Gallagher has called for greater electronic trading of bonds. So it's not a problem. It's something that regulators need to pay attention to. If I could just briefly respond to the point about inventories. Inventories were at their heights in the run-up to and during the financial crisis, and that resulted in massive losses and failures of the largest financial institutions around the world. The decline in inventories and the increase in capital means that dealers are actually now positioned to take on inventories when it makes economic sense, when the market making makes sense, and so that they're capitalized to absorb the risk that they're going to take. That's what we mean by financial.
My time
That's simply not true.
Time has expired.
That's simply not true. That is not, cause and effect don't work that way. It is not that they have now positioned themselves deliberately because of the capital they're holding. That's not how capital works. They have dropped their inventory because of the fact that they have these capital charges associated with their inventory positions.
Thank
I
you.
yield back.
Thank you. Mr. Duffy, recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Carfang, what role did prop trading have in the financial crisis?
Banks trade for their own portfolios, and they do that primarily to accommodate their customer activity as well as profit themselves.
Was it a root cause of the financial crisis?
Absolutely not.
I would agree. So would you agree that Volcker caused a reduction of providers and sources of liquidity in fixed income securities?
Right. I believe the Volcker rule has caused less trading and therefore wider spreads.
And so now where does that new liquidity come from?
Well, the liquidity comes from banks, and it comes from all the participants in the capital market.
Maybe this is to Ms. Coffey as well. Do you guys, either of you, see any additional downside risk with these new liquidity providers at times of market stress?
I mean, absolutely. One of the things that you need to think about is, do you have two-way liquidity or do you have one-way liquidity? What's very important with market makers is they provide two-way liquidity. They will buy and they will sell. When you have many market participants, they might all be buying or all be selling at the same time, and that is something very important to bear in mind.
Okay. And Mr. Carfang, I think you made an interesting point in regard to the high school chemistry set. You might see one potion or powder and how that behaves in its vial by itself, but when you put all three vials together, we actually don't know what happens. So if you look at risk retention, Basel, and Volcker, do we actually know the consequence on our markets with these three combined?
Well, and what we're seeing when these three combined is those institutions of the absolute highest quality have liquidity, they have low spreads, they have inventories, they have traders in their securities, but everyone else is being crowded out.
Yeah.
All but the highest quality borrowers, have access now. We see, Basel III is what we refer to as being pro-cyclical. So when things are fine and markets are not in stress, there's plenty of capital, there's low rates, low spreads. But in times of stress, Basel III actually requires banks to hold more liquidity, more treasury bills. And we actually foresee what could be a hoarding and a real collateral crisis when we do have markets in greater stress. We don't know. We haven't seen how the markets and how this chemical reaction is going to take place when you add financial stress. You add the Fed unwind and a number of unknowns that are still playing out.
Have we seen any warning signs with whether we look back to October or to August of this past year, where we have any market stress and what happens to liquidity?
Oh, we had the Treasury flash crash. We're also seeing pockets of illiquidity in the municipal bond market from time to time. We're seeing trading gaps because of very high volatility. Big fluctuations in price are the result of low inventories and wide spreads.
So you guys are all aware of Lord Hill, Jonathan Hill from the EU, and they've actually taken a pause or recommended a pause in the EU because I think there's an understanding that we don't know, like your chemistry set, the consequences on our markets, on our economy, on our growth, that all of these rules are going to have on one another. Is there something that we know on why all these rules are going to work that the Europeans don't know? Or is there something they know that we don't know?
Well, in the early part of the decade after the crisis, there was a regulatory arms race. Other central banks are taking a pause. We are not. Many of the regulations are actually improving the safety and soundness of the system. I'm not here to advocate that these regulations be ripped apart, but it's that chemical reaction that we haven't taken a deep breath, we haven't stepped back to understand what all these unintended consequences are. When a municipality can't sell a note to a money market fund to meet a payroll, that's a problem.
Ms. Coffey, would you agree that we don't know the consequence in times of market stress, how all of these rules are going to impact our
Absolutely.
markets?
I'd say there are more than 3 chemicals, and I certainly hope nobody blows up the school.
Is it possible the school gets blown up here?
I certainly hope not, but I think there are definitely questions that when you start layering all these different factors on top of each other, nobody knows how it turns out.
At the margin, behavior changes. And yes, there will be a school that's not built. There will be a hospital that's not built.
Very quickly, did mortgage-backed securities have anything to do with the crisis? Did that have anything to do with Dodd-Frank? And does anyone know if there was any reform to Fannie and Freddie in regard to
Quick
Dodd-Frank
answer.
reform?
Residential mortgage-backed
That's a
securities
huge
were at the
question.
heart of the crisis, Congressman.
And was Fannie and Freddie part of our mortgage-backed securities?
Certainly, they were encouraging a lot of federally guaranteed mortgages.
And was there any reform to Fannie and Freddie in Dodd-Frank? Do you know?
No, there was not.
I yield.
Okay.
Can I just jump in on the question as to, do we know?
I'm going to try to keep it even and give the gentleman from California another 20 seconds too on the end of his, so we stay. But thank you. Gentleman from California is up for 5
Thank the
minutes.
chair and ranking member for having these hearings because there's far more money involved in the bond market than the stock market, and whether American businesses can provide jobs and expand depend, I think, a lot more on the fixed income or debt instruments. What's missing from the panel is the bond rating agencies, which gave us, I think, are almost entirely responsible for the 2008 collapse. They gave AAA to Alt-A. I've talked to people who put together mutual fund portfolios, and they say, how can I not have the highest yield with the highest rating? If I turn down a AA rated security that pays 5 basis points more than some other AA rated security that I think is more sound, then people look at the portfolio and they just say, I have 5 basis points less. Who's going to invest in a mutual fund that pays 5 basis points less? So the credit rating agencies are the only way for the individual investor to evaluate a portfolio. I've had people in this room so desperate to defend the credit rating agencies that they say, well, in valuing a bond portfolio, don't pay attention to the credit rating. These, of course, are the credit rating agencies whose last refuge is to say, don't pay attention to what we say because you know we've been paid to say it. I would not attend a baseball game if the umpire was selected and paid by one of the teams. But we've covered in this the credit risk that individual investors face. And risk retention may focus on that. We haven't talked at all about the interest rate risk. We live so long in a zero inflation world or 2% inflation world that we have forgotten the 1980s. Retired people are stressed by the low nominal rates they're getting. And at 8%, if they were getting 8% on their money in a 6% inflation world, they'd be happy. They'd be eroding their capital by 6% a year. They wouldn't notice. They live in a nominal world. The people in this room live with real interest rates. But now they're getting 2% in a 0% inflation world or 3% and 1% inflation world, and they're desperate to get a higher nominal rate. And they are playing with high risk yield, and they may be driven to take credit risks, but they also may be driven to go out longer and take a bigger credit risk. Let me ask Mr. Johns, is there a market for, and are people issuing, other than TIPS, inflation-adjusted debt securities for people to buy, other than the federal government's TIPS program?
Yeah, from a securitization perspective, I'm not aware of anything.
Okay. So, Ms. Coffey?
I would note that non-investment grade loans are actually tied to 3-month LIBOR. Therefore, they are floating rate and are not
I missed the
subject to
first part of your answer. What is
non-investment grade loans, the loans that finance companies like Cablevision and Dunkin' Donuts, are floating rate instruments. They are tied to 3-month LIBOR,
Gotcha.
and therefore they are not subject to
So
interest
they're
rate risk.
regarded as high risk because you're not sure Dunkin' Donuts is going to sell enough donuts, and yet the 30-year Treasury may be the thing that loses half your money for you. Because if we live in, I haven't done the calculations, but if we go to 10% inflation, I assume the 30-year Treasury loses what, about half its value? So you can lose half your money on the Treasury, and it may be safer to buy the donuts.
Certainly if I'm the consumer of the donuts.
Is anyone else on the panel aware of floating rate instruments and or inflation-adjusted instruments? Well, we should talk about my mother's portfolio because what is being done are we doing enough to warn individual investors about the interest rate and inflation risk? Mr. Green.
If I could add on that, I think that transparency is the key here. In 2002, FINRA introduced the TRACE reporting system, which brought down costs significantly in the fixed income markets. There's a lot more we can do. There are proposals out there that are expected to move forward.
Do any of their proposals exist the fact that in a absolutely transparent 30-year Treasury bond that everybody thinks is super secure, you can lose half your money if there's a change in the inflation rate? What can we do to warn people more of that interest rate risk? Because they live in a world where they think the 30-year Treasury is really safe and the donuts aren't. Is there anything else we can do to warn people of the interest rate risk?
Well, I'd absolutely agree that there's more.
What do we do?
We need to increase the disclosures and the financial education. There's a lot more that the
There's
investment
no risk
advisors
statement on
and
the 30-year
broker-dealers
Treasury. I
can-
yield back.
Thank you, Mr. Sherman. The chair now recognizes Ms. Wagner for a period of 5 minutes.
Thank you, Mr. Chairman, and thank you all for joining us today to discuss some important regulatory issues facing our fixed income markets, which are vital for keeping the cost of credit down for consumers and for businesses. In addition, if and when, as we are discussing, the Federal Reserve continues to raise interest rates beyond what they did in December, that will apply further pressure on this market, which will require a strong framework and measures to ensure that there is enough liquidity to continue trading these securities. As we've already seen, Dodd-Frank has greatly weakened the ability of participants to react to market events, from the Volcker Rule to new risk retention provisions that will go into effect later this year. Ms. Coffey, while the financial crisis was largely a result, as we've discussed, of non-performing loans in the residential mortgage space, how did the loans that this risk retention rule target fare during the financial crisis?
Certainly. One of the things to bear in mind with these non-investment grade loans is that they're senior secured. So first of all, the companies tend to perform very well and worked through the financial crisis well. And secondly, even if a few of the companies did default, the recovery given default was extraordinarily high, more than 80 cents on the dollar. As a result, investments that invested in these structures, like CLOs, performed extraordinarily well, had de minimis default rates, even lower default rates than we saw on investment-grade corporate bonds, for example.
Performed extraordinarily well. Yet the risk retention rules don't seem to acknowledge the fact that these securities performed extraordinarily well, which, as you noted in your testimony, helped finance more than 1,200 companies that employ more than 6 million people. Why is that?
So why did it not, why does risk retention particularly hit CLOs?
Yes.
I think in part it's because of a bad acronym. People see CLOs, they think CDOs, and they don't take the time to separate out that CLOs actually provide financing to American companies. I think that is the big difference. We spend a lot of time talking to the agencies and speaking with lawmakers about structuring a way to have risk retention that fully comports with the Dodd-Frank Act, but that would still permit CLOs to continue to survive. That's in H.R. 4166.
Right.
We think that's a good solution.
Great. All right, Mr. Johns, despite the past performance and strong fundamentals of many of these loans, our regulators categorically decided that any asset-based security does not qualify as a high-quality liquid asset. Why is this the case?
I think it's an over-exuberance of regulation in the short basis. I think it's a failure just to recognize that, while we represent issuers and investors, so some investors are obviously in favor of risk retention, issuers, fear the capital burden. There's a sort of ebb and flow of and push and pull of opinion there. But what is clear to me is that, from these changes, whether it's Dodd-Frank or the changes that you see in Europe that are very similar to Dodd-Frank in securities land, there are some positives that have come out of here. That you have risk retention, you have increased disclosure, you have changes to the rating agency process. There's a lot of things that, whether you agree with the degree of it or not, some good has come out of it. So what I can't understand is why, if you're Basel or if you're one of the joint agency regulators, why you're not rewarding good behavior. I think the reference to insurance was put out earlier, today. Think of capital like insurance. Your insurance premiums go down if you are a good driver. So if you're putting in place aspects to your program that actually make it a safer product for investors, that they make it more transparent, that there's increased risk retention, whether you agree with the risk retention or not, at least reward that behavior by making sure that it is treated as liquid. I'm hearing these guys saying here that we don't have a liquidity problem. Well, if we've not got a liquidity problem, why on earth can't we treat these as liquid assets? It makes absolutely no sense to me how, the two gentlemen to my right and left here are telling me something that I'm actually, saying, yeah, we have an issue with liquidity with the capital, but the actual liquidity in the nature of the asset itself should be rewarded.
Just in my limited time left to close, what are the real-world consequences of reduced liquidity in the corporate bond market for U.S. companies, their employees, and individuals saving for retirement to send their kids to college? Why does this matter? Quickly.
Ultimately it means that money's not being lent to folks who need to deliver that money to the real economy.
Thank you.
Appreciate it.
Gentlelady's time has expired. The chair now recognizes Mr. Lynch for a period of 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member. Good morning, and thank you for your testimony this morning. Let me take the small problem I have, and Mr. Plunkett, you've got this naming problem that seems to be uniquely affecting Natixis and nobody else. Can I ask you, have you tried to resolve this in a regulatory setting or administratively, or do you think that legislation is required?
Thank you, Representative Lynch. We have talked to the regulators about it, and they were very clear. We even submitted a formal request for guidance in our particular situation, and they were very clear that they felt that there was no flexibility in the Volcker Rule legislation for them to regulate.
I'm good. Okay. I agree with you, and maybe we can fix that in one of the bills coming up. Let me ask you, Mr. Stanley and Mr. Green, there's rather a benign view of CLOs this morning. But I was here during the crisis, and even though the 10-year average might be good, during that stress period, we had some problems. The fact that the taxpayers pumped $970 billion into the markets, and we created a commercial paper facility and did all these things to kind of prop things up, did that have anything to do with the relatively better performance of CLOs?
Absolutely. There was trillions of dollars of public liquidity support into the market during the crisis. So you can talk about the relative performance of different assets, but I don't think that you can say that any asset is totally healthy on its own without that kind of support. And I would just also say that the CLO market was very different in 2007 than it is today. In 2007, less than 30% of CLO loans were what's called covenant light, which is more dangerous in terms of paying back. Now over 70% are. And we've seen enormous increases in the issuance of CLOs, and in the reach for yield environment created by low interest rates, we've seen very compressed spreads on these high yield loans. So I would ask the other panelists here, would you feel more comfortable if our banks were loaded up with these CLOs that are currently dropping in value in the market as the Fed started to raise interest rates? Would you feel more comfortable about the state of the financial system?
That will have to remain a rhetorical question, because you'll take all my time. Mr. Green, anything else to add? Thank you, Mr. Stanley. Doctor.
I would add that the leveraged loan market, it was the corporate and the last financial crisis, the corporate performance was not at the heart of it. But if we look around the world, there are a range of financial crises. Look at Japan, where corporate loans drove failure there. So we have to be on guard for the whole range of these things, and that's why regulators have been calling out the leveraged loan market, which is what is a lot of.
Let me drill down on it a little bit more. At the core of the failure, though, was the issue of securitization for distribution, where folks could just pump out these securities and escape any type of skin in the game or any type of negative consequences of pushing them out on the market. 41, the new bill here that's being pushed with respect to, I think it's 4166, right, HR 4166, suggests that for a $100 million issuance, it'd only be $400,000 of negative consequence to the issuer. Now, isn't that a furtherance of sort of no skin in the game, just pushing? That's the stuff that got us in trouble in the first place.
Absolutely. I think it just totally undoes the positive incentive effects that were intended to be created by risk retention. And if you look at the CLO market right now, there was a recent J.P. Morgan study that found that over half of the mezzanine level tranches of CLOs, this is not the equity, this is mezzanine levels of tranches were showing mark-to-market losses, and that's an increase from less than 1% in September 2015. So this is a market that's under stress. It can show losses. We need to have the right incentives there.
And if I could add to that, what we see in Europe, with Lord Hill hitting a pause on better capital rating performance, with the simple, transparent, comparable work they're doing, there is actually not necessarily leading to better results. We see European banks taking a bloodbath on their stocks. U.S. firms are holding up because of the strength of our regulation.
Yeah, STC hasn't been implemented in Europe, so it's irrelevant.
Reclaiming my time, please. Reclaiming my time. I yield back. Thank you.
Chair now recognizes Mr. Poliquin for a period of 5 minutes.
Thank you, Mr. Chair, very much. I appreciate it, and thank you all very much for coming here today. This is a really important education for a lot of us. Everybody in government should do everything humanly possible to help our companies grow, whether here in Washington or in state or the local government, right? I mean, we're all here to help. And when you have companies that are able to grow and hire more workers and pay their workers more money, you have less people dependent on the government. And I come from Maine. I mean, we're pretty tough and resilient up there. And I mean the real Maine, western, northern, central, and down east Maine, not northern Massachusetts. I mean the real Maine. And we like to consider ourselves independent. So I'm looking at this whole problem of liquidity and volatility in the financial markets, in particular the fixed income market. And when you have lots of volatility with wide price swings, probably brought on, I would argue brought on, by a lack of liquidity in the market because of these smothering financial regulations, does two things. First of all, companies who decide to access the capital markets to borrow by selling bonds so they can grow and hire more workers instead of borrowing from a bank or a credit union, well, they have less opportunity to do that. So there's less opportunity to grow and for our economy to grow. And also for our seniors who are using fixed income investments as a stability against an equity portfolio, they get discouraged also. So my question to you is the following, and Mr. Carfang, I'd like to address this to you. I'm looking at FSOC. Now, this is a group of regulators. Some of the biggest, heaviest, most in-the-weeds regulators we have in the world are on this board. And they pick apart all the different players in the asset management space, all the different players in the insurance space. And they say, you know, are these folks too big to fail? I came from the money management business. Now, I'll tell you, if you and I are competing and you're managing pension funds and I'm managing pension funds and my performance is better than yours, then your clients are going to come to me, and if you get in trouble, you represent absolutely no systemic risk to the market because the assets are held at a custodian bank. We're agents. What systemic risk do we provide to the economy or to the capital markets? We don't. Now, I'm looking at this whole thing that FSOC's doing. Why in the world shouldn't they be spending their time looking at fixed income market risk? When you have less liquidity in the fixed income market. Isn't that systemically risky to the economy, into the financial markets, and our ability to grow as a country and provide more opportunities for people? What do you think of that, sir?
I think the FSOC actually creates double jeopardy and creates a culture of indecision on the part of our financial institutions and the investors. Financial institutions are not only subject to their specific regulators, but should FSOC not like the outcome that the regulator has, they have a second bite at the apple. And that absolutely slows down creativity, it slows down economic activity, job creation. To me, the FSOC is probably one of the most serious problems that we have in the sense that they're overreaching now into asset management and things that have absolutely nothing to do with truly systemic risk.
Why doesn't the SEC focus on that? The SEC's been overseeing asset managers for 80 years. They do a pretty good job, don't they?
Well, they have a tremendous track record. The SEC, in fact, was working on money market fund regulation that I spoke to in my testimony, and was ultimately sort of strong-armed by FSOC into coming up with the regulations that are now damaging the tax-exempt and prime markets.
Thank you, Mr. Carfang. I think this is an example of big, heavy, intrusive government. You know, the administration's financial regulations that are smothering, you know, we're the envy of the world. We get the best capital markets in the world, most diverse, most liquid, deepest. Why do we want to destroy that? I'd like to move on, if I can, to you, Mr. Plunkett. I want to make sure I understand this. You're mentioning H.R. 4096. Now, you folks, your organization, Natixis, am I pronouncing that correctly?
Yes.
Natixis. I'm pretty close. I'm from Maine, so, you know, so we do the best we can, unlike the folks from New Jersey. But in any event, you're a French bank, or your holding company is a French bank, and you own asset managers here in America, including Loomis Sayles, I believe.
That's right.
That's been around forever, right? So I'm an investor, and I'm a retired auto mechanic from Bangor, Maine. My wife's a nurse, and we're putting aside, you know, $50 a week or a month to save for our retirement, and we want to hire Loomis Sayles. Shouldn't I want all the information humanly possible to know that the brand, the name, and the company that I'm hiring, I have all that information? Now, talk to me a little bit about the naming problem here that 4096 is trying to correct.
4096 is trying to simplify the communications between the manager and the end investor and make it really clear from the beginning that which manager is managing which fund.
And that's very important, right?
It's just trying to simplify and make more transparent.
Okay. Thank you very much. Thank you, Mr.
Gentleman's
Chair. Thank
time
you,
has
Mr.
expired. The chair now recognizes Mr. Hill for a period of 5 minutes.
Thank you, Mr. Vice Chairman. Appreciate the topic of this hearing. You know, we're here because we keep having testimony on monetary policy in this committee, and yet all of our regulators, when we talk about monetary policy, we're at zero, and we still have an economy that's subpar and not growing, and capital is not being allocated. So I'm glad we have a hearing today that talks about non-monetary policy structural impediments to economic growth, which is what I think the topic is today. You know, we want to encourage private capital flows into institutional corporate-grade commercial real estate. And these products are for institutional investors. And I think that's something that all the members of the committee understand. We're talking about institutional products here, not products being marketed to retail investors. And secondly, in my view, in looking at the proposed rules on commercial mortgage-backed securities, private capital flows will be severely curtailed under the proposed regulatory rules that are being considered. And they're on top of the existing portfolio and Basel capital rules that our panel has talked about. Also, when I look at this topic, the regulators' proposals for residential mortgage-backed securities are generous. And yet they were at the heart of the crisis. And yet in the qualified approach to residential mortgages, 85% would qualify. But for commercial mortgage-backed securities, around which there were no demonstrated contribution to the crisis, these proposed rules will only have 3 to 8% of the market qualify. And that's back testing from 1997 through 2013 or so. So That's got to raise concerns that we are hurting private capital flows and that we're not being fair balanced as it relates to the commercial market. If you look at default rates, which to me is the stress test, who needs a stress test when we've been through the market that we've been through? So we've got it. We've got the data. And on the subject of single asset, single borrower securities, which is partially addressed in my draft, they only had 25 basis points as a historical loss ratio over that backtesting period. And if you include even 07, which was the worst year, it was 1.77% as a default rate, which is still, in the great scheme of life, if you're in the real world, not the academic world, that's a pretty good default rate. I also read in the Democratic comments in the packet today that somehow people are concerned about cross-collateralization, that somehow that's a bad thing. I can tell you as a banker for 35 years, that's a dream thing. That's a good thing to have a single asset, single borrower entity that's cross-collateralized because it actually is in the creditor's favor and reduces the possibility of collapse of that asset category, not enhances it, as argued in a memorandum from the opposition. And then finally, I'm curious about the proposed rules for commercial mortgage exceptions, that they're just, I don't know how they came up with these rules. Some of the parameters that we talk about in my draft might be appropriate in a community bank loan to an individual borrower, but they don't reflect the institutional market for commercial mortgage transactions, and so they don't seem to be well placed, and I'm sure we'll have more conversation about that. But I'd like to ask a question of Mr. Renna. Why is it even necessary for Congress to insert itself in this setting the rules, if you will, and trying to determine this qualified rulemaking? Because, I mean, this has been going on for 2 years, and I'm trying to explain what interaction you've had with our regulators, what data you've provided them. Could you give us a snapshot of that, please?
Absolutely. Thank you, Congressman. You did a terrific job summarizing what's going on in the CMBS industry. With respect to why we are here asking Congress to intervene is that, one, as I said in my opening statement, we acknowledge the daunting task that regulators had to administer Dodd-Frank, and particularly with respect to risk retention. They told us we would love one broad-based, elegant rule that applied to all asset classes. That would be the simplest way to do it. Unfortunately, the world is not a simple place. There are many different types of asset-backed securities. CMBS is just one of them. They all have their own characteristics. What we tried to demonstrate to the regulators is that the way to achieve your risk retention goal, yet allow the industry to function as efficiently as possible, would be to accept these certain modifications we are requesting in our comment letter to you. And one of those was with respect to exempting single asset, single borrower from risk retention for the basic and simple reason was it's not a conduit security.
Time has expired.
You're back.
Gentleman, Scott, I believe you passed before you.
Yes, thank you.
All set?
Yeah.
Okay. Gentleman is recognized for 5 minutes.
Thank you. Mr. Rayner, let me ask you, because maybe the general public, those watching on C-SPAN, really need to get a good understanding of the difference between commercial real estate and residential real estate. And where is that differential balanced at?
Thank you, Congressman. It's very simple. A residential mortgage loan is underwritten based on the credit quality of the borrower. They're going to look at how much money do you make, how much do you have in your savings, and determine whether they're going to make a loan to you for a home mortgage. With respect to commercial financing, they're not looking at the borrower to underwrite their loan. They're looking at the asset and the cash flow that comes from the various tenants that are within that asset, and then also the unique characteristics of that particular building. How old is it? How technologically modern is it? Other factors that will go into determining whether it is qualified for a loan, for a mortgage to be applied to that asset, not to the borrower.
I am very concerned that we continue to make sure that businesses in the commercial market have access to a variety of financing options. So let me ask you, if you can expand upon, you're familiar with, I guess it may have been, I'm sorry, getting to the meeting, I had another one, but the CLOs, right? You're familiar with the CLOs, is that correct? Are you?
I am familiar, but I'm not the experts that people on the panel are with respect to CLOs.
Let me ask you this. How are our government regulations making it more difficult, in your opinion, for commercial real estate?
Basically, there's kind of a piling on effect of a number of regulatory initiatives that are requiring basically the holding back, the reserving of capital against commercial loans that lenders make. In addition to that, it's the uncertainty in how it applies. So it's the amount of capital that the regulations require lenders to hold with respect to making a loan, and it's also the uncertainty as to how the rules apply. Risk retention is an example of that. The regulators were very broad in discussing how risk retention is to apply. So as now the industry has to figure out how do we comply with that, there are many, many open questions to that. So what we're asking for from the regulators, and now we're asking for Congress, is some specific guidance with respect to helping us on the most important issues that will allow the market to operate efficiently.
Risk retention, I got it. Ms. Coffey, I want to talk a little bit about the CLOs. I'm working with my Republican friend, Mr. Barr, on a CLO bill, House Resolution 4166, which is expanding the Proven Financing of American Employers Act. So tell me, why do we need this act? Why do we need this bill?
Absolutely. Thank you very much, Congressman. We need this bill for a couple of reasons. First of all, the risk retention rule, as it's written, is extremely and very much overbroad. What the Dodd-Frank Act said is that the securitizer must retain 5% of the credit risk of the assets being securitized. The way the final rule is written is that regardless of what the assets are, the securitizer must retain 5% of the full amount of the securitization. That's not 5% of the credit risk. 5% of the credit risk is a much smaller amount. If we could move it to the amount that is 5% of the credit risk, which H.R. 4166 does, then smaller managers will be able to continue to provide financing to U.S. companies. To give one quick example, in 2014, 30 managers accessed the CLO market, issued CLOs. These managers were not able to issue CLOs in 2015, all due to risk retention looming. That is a problem. We can resolve it with H.R. 4166.
Well, both Representative Parr and myself feel that passage of this bill will help increase jobs. Do you agree with that?
I absolutely do. It will continue providing financing for important U.S. companies. Without that financing, those companies cannot grow and cannot continue to create jobs.
Thank you very much. Thank you, Mr. Chairman.
Mr. Schweikert, recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Johns, and first, your written testimony is actually, I'm going to have all my interns read it. It's actually, no, it's well done. In your both verbal testimony and here, you had a conversation about, okay, how about the contract obligations? You know, we're talking about risk retention. You know, I want you to go into that a little bit more, and then I want to move the conversation into the opportunity to say, okay, here's what, you know, the review of our trading book says. What can you contractually also buy a hedge, buy an additional insurance on that risk?
Okay. So the point about contractual obligations is, you know, when you look at a securitization contract, ultimately it transfers risk to investors. I don't think you can argue that transfer, you know, did occur. If you look at the losses that investors took during the crisis, it's you know, pretty well documented that investors did take losses. When FASB brought back these transactions on balance sheet, which I don't think we're necessarily objecting to. Disclosure of the obligations, I think generally is a positive thing. The issue you get is that you're now disclosing something where the risk has been transferred. And capital rules do not allow for recognition of that difference. So you end up, from an accounting perspective, creating loss reserves, and you hold capital against it.
It's important we say that maybe one more time.
Well, let me give you some numbers.
Risk has been transferred, but yet you're still carrying it under your accounting rules.
You've transferred your risk. You have no contractual obligation to take that risk down, and yet you're still holding capital against it. Let me give you some numbers here. This is, if you look at the crisis, if you're a credit card, losses generally track unemployment rate up until a point, because a credit card only has a life of about 8 to 12 months. So if you're more than a year into a crisis, you've already seen your tightened underwriting manifest itself in performance of credit card. But let's say you're at 10%. You say unemployment in the last crisis went past 10%, your losses may track up to that. At the same time, you're being asked to hold 10% capital against that risk. So now, if you look at the combined effect on your capital position through a write-down on your equity by providing loan loss reserves and the 10% capital you've got to hold, now you've got 20-something%. If you equate that to what that means for unemployment, you're really talking about 25+%, which the last time we saw 25% unemployment was in the Great Depression, not the Great Recession.
Okay, so the point is pretty simple, hopefully for everyone here, that whether it be an automobile, floor plan, credit card, you've already transferred the obligation or the risk portion of the paper, and now under Dodd-Frank we're asking you to retain something that you've already transferred.
Exactly. So even if you're a regulator saying, well, we have to hold capital against the unexpected loss, if you're an accountant, how can you say the expected loss is actually assuming that you're going to unilaterally break the contract that you have with an investor? That, to me, doesn't make any sense at all. And it's penalizing the economy in terms of billions of dollars that could be released back if you release that equity.
Well, and it's paper. I mean, it's basically a paper obligation you're carrying on your books that you can no longer put out on the street.
Correct.
Second mechanic on that, I've always wanted to touch on your ability for that paper obligation, even though you've actually already transferred it with those who chose to purchase the bond. Is it hedgeable? What's on your book? I mean, could you buy a insurance product on it, and would that be accepted?
I mean, technically, I think yes, it is. We would have to go back to our members and sort of talk about how you could hedge that. I don't really want to get into the world of credit default swaps in front of this audience right now.
But my understanding is the regulators would not give you much credit for having bought that.
That's correct.
So even if you were to add that additional layer because of your paper obligation, you still don't get much benefit to it.
It wouldn't make a lot of economic sense.
Also, in your written testimony, you actually do touch on a common securitization platform. In the last 20 seconds, tell me why it's wonderful.
Sorry, say that again?
Tell me your thoughts on it.
I think we are supportive of a common securitization platform. That's through Freddie and Fannie effectively combining forces to create one entity. The benefits of that, of course, are if you combine a Freddie and a Fannie security, you've now effectively merged two markets into one. And we all know that the larger the market is, generally the more liquid it is.
And I know I'm over time, Mr. Chairman, but the benefits of a common securitization platform, commonality in information disclosure, commonality in products, so the ability to purchase and actually see visibility.
Correct. And by commonality, you create consistency automatically between the two securities that have now been merged to one.
Thank you, Mr. Chairman. Yield back.
Thank you. I believe Mr. Holtgren is next.
Thank you, Mr. Chairman. Thank you all for being here. I really do appreciate your work and your input on these important issues. I'm going to address my first question to Mr. Renna. Is that right? Renna. Okay. I've got a couple questions for you, so I'll kind of package them together and see if you can respond to this. Wondered, did the regulators, as they were preparing the rules to implement Section 941, the risk retention requirements under the Dodd-Frank Act, have an opportunity to provide flexibility to the commercial real estate market Wonder what will the effects of this rule be on single asset loans? If it would not undermine investor protection or stability of the market, why wouldn't they use this flexibility? And then if you could talk briefly about Mr. Hill's draft legislation, would that help with this?
Well, to your second question, yes, it absolutely would help with it. The issue with single asset, single borrowers, again, because my point that regulators did not want to get into the level of discernment in drafting the regulations to specific asset types that was necessary in order to achieve the goal of risk retention, yet also allow the sector to be able to function efficiently. Single asset, single borrower loans weren't in any realm within the problem of what happened in the downturn of packaging of bad loans that investors had no idea what was in them. They're a single asset that is has a single mortgage on it. Investors can very clearly see how to underwrite that asset. They want to be able to invest in the bonds that are produced by that. We provided data to the regulators explaining the historical performance of this asset class and making these other arguments that the rules should not apply to it. They just did not want to get to that level of discernment. As a result, you're now applying a cost on single asset, single borrower securitization that has no prudential benefit to it whatsoever. That is going to result in the capacity for that. If you want less of something, tax it. Essentially, risk retention is a tax. And you're taxing single asset, single borrower, and you're going to be reducing the capacity of it.
Thank you. Switching, I'm going to address a couple questions to Mr. Plunkett, if I may. Mr. Plunkett, about H.R. 4096, the bill put forward by Mr. Capuano and Mr. Stivers. I wonder if you could explain what customer confusion might be caused by the name-sharing prohibition of the Volcker Rule, what impact this would have on the funds in your network, and if you could just explain briefly why we would need, why you think H.R. 4096 might be helpful in this.
Thanks very much. It's noteworthy that in certain foreign jurisdictions, the regulators actually require that the name of the manager be part of the fund because they want to make sure that investors know exactly who's managing the fund. H.R. 4096 is simply a hyper-technical amendment to make it easier to simply permit greater transparency by having the name of the manager in the fund if the manager thinks that's beneficial.
Okay, thank you. I'm going to switch back for my last couple minutes here. I'm actually going to, Mr. Carfang, if I can address some questions to you. And I think if I understand it correctly, you're visiting us from Chicago today, so glad you're here and glad you didn't get hit by the weather going through Chicago. Hopefully we'll all be able to make it back later this week. But I know you mentioned earlier today that the municipal securities market has seen some liquidity challenges recently. What do you see as the major causes?
I think the money market fund regulations, which are being phased in now through October, are causing investors to withdraw assets. In the tax-exempt market, for example, institutional money market funds have to move to a fluctuating net asset value and are subject to fees and gates and are limited to what the SEC defines as non-natural persons. Most banks have to stand on their heads to figure out what a non-natural person is and reclassify accounts. They're simply not doing that and withdrawing the funds. 45 funds have already closed.
Mr. Carfang, could you explain how the Volcker Rule impacted the cost of hedging risk and what consequences this would have for businesses and other customers of banks?
Okay, well, the Volcker Rule and the prohibition of proprietary trading reduces volumes and reduces the size of dealer inventories, which increases the spreads. Those wider spreads, when a farmer is trying to hedge a product, they're paying a higher cost. And what will happen is, at the margin, there will, some will make decisions to actually go naked and not hedge to take the risk themselves. When the risks are centralized, through clearinghouses or within banks, they're very visible. They can be quantified, they can be managed. When the risks are dispersed through hundreds of farms or co-ops or thousands or whatever, the risks fall in the hands of those probably least able to understand and have market access to manage them.
See, my time has expired. Thank you all for being here. Chairman, thank you for the time. I yield back.
Mr. Stivers, recognized.
Thank you very much, Mr. Chairman. Thanks for holding this hearing on a lot of important proposals that are coming before this committee, and I appreciate all of your time for being here and spending some time with us. And Mr. Plunkett, I want to follow up on a question that the gentleman from Illinois just asked you about H.R. 4096 that Mr. Capuano and I are sponsoring. Do you think this legislation is any kind of meaningful alteration of the intent of the VOCLA rule?
No, Congressman. It preserves the basic intent of the VOCLA rule provision, which prohibits, is really intended to keep the name of the bank itself off the name of the hedge fund.
And so this proposal actually will help give investors more information, but not confusing information. Is that correct?
It will give them the name of the manager, which in the case that the bill addresses is totally different from the bank already.
Yeah, exactly. Well, thank you so much for that. And Mr. Carfang, I've got a question on the VOCLA rule. Do you believe the VOCLA rule is driving part of our liquidity problems that people are talking about a lot in the marketplace?
Oh, absolutely. It's causing dealers to not be as active in the marketplace. Many dealers are actually now focusing on fewer markets. So you have market makers that used to be very broad and make markets in a lot of debt securities and fixed income products are now specializing in just a few, which then makes all the participants beholden to just a few market makers in every security. That's risky.
And what does that mean for investors and anybody that has to access the market by buying and selling securities, bonds, or anything that
well, it generally means either higher cost or lack of supply, lack of access to the market completely.
And can it mean, it basically means both or some combination of the two?
Oh, generally it is a combination of the two.
And there's been a PwC study that talked about the regulatory impacts that were helping create this liquidity problem. Have you seen any other studies with similar conclusions?
Well, the U.S. Treasury itself, through its Tayback report, actually talks about collateral scarcity and the fact that when you add up the collateral requirements in terms of HQLA, liquidity buffers in money market funds, capital buffers in banks across the board, the sum of the requirements for high-quality liquid assets basically consumes all high-quality liquid assets in the marketplace. So you've really put a binding constraint on economic activity.
If you were advising the FSOC or the Office of Financial Research, do you think this is a subject they should look into?
Absolutely. Short of their own dissolution, this is one of the most important things.
I would just maybe I don't think it's just FSOC who should be looking into this. I would encourage the regulators should be doing their own review. I would advise more hearings of this nature. We totally endorse that.
Well, what about the OFR, who's responsible under Dodd-Frank, a bill that you supported, to do research on systemic problems? Shouldn't they research this? It's their job to research.
Understood. I mean, I think, frankly, from the perspective of SFIG, we would encourage as many studies across the board as we can possibly get on this. There are some very real impacts happening right now, and we haven't even seen Dodd-Frank finish its implementation. We're not going to see that for another 2 or 3 years. So the most liquid market in the world right now is suffering, while in Europe, which has never been as liquid as the US, we're seeing actions already being taken to try to sort of make sure that they don't over-regulate.
Yeah, and I think that this coming crisis has lots of causes, but one of them is directly at regulators and especially the VOCLA rule. And so we need to make sure that we can understand the causes and the impacts on consumers, investors, and the marketplace and what it means for volume and how some of it will move overseas. And we also need to make sure that we address it as quickly as we can in a meaningful way and mitigate the problems created by it.
Completely agree.
Yeah. Thank you. I yield back the balance of my time, Mr. Chairman.
Thank you. The gentleman from California, Mr. Royce.
Thank you, Mr. Chairman. Mr. Reyna, when you suggest that $200 billion of commercial mortgage-backed securities in the marketplace, that will require refinancing, you say, over the next 2 years, what would happen to borrowers
if CMBS lending is insufficient to cover that need of that sum?
Thank you, Mr. Royce. Basically, the borrowers become more in distress because if they have to go to a different type of lender, the CMBS lender is a very efficient lender that gives them best price and proceeds. It also provides them with a 10-year fixed loan that is non-recourse in nature. If they have to go to a different lender to refinance their asset when their loan comes due, they are probably going to go to a lender that is going to can only provide them shorter term, perhaps a floating rate loan, and will require recourse. All those things mean, to cut through the technicalities, the borrower is not going to be able to borrow as much for their asset. They're going to have to put up more equity, and if they can't do that, then they're going to be in default.
So what would the economic impact be, let's say, for pension funds or, say, life insurance? When you look at constituents out there, how would that affect them?
Sure. The performance of the bonds is what the pension funds and life insurance companies are interested in. If the underlying mortgage are not performing because when they come up to refinance, they have difficulty refinancing, then their investment is going to suffer as a result of that. And going forward, when they want to go and reinvest in those types of CMBS bonds that provide them the risk-adjusted return they're looking for, there's not going to be as much of that in the marketplace for insurance companies and pension funds to invest in, to provide them with the cash flow they need to match up with their needs with respect to beneficiaries.
So, as you know, European regulators are considering a high-quality securitization framework that could differ from U.S. rules. It appears that in Europe, they recognize that the current rules under consideration in their argument may be too onerous to support a liquid ABS market. If we don't have global convergence on these rules, what would that impact be on the U.S.? I'll ask Mr. Johns that question.
Well, if you don't have global convergence, you've got two issues. Number one, if Europe just goes its own way, then you'll see European collateral gets the capital relief. European investors get to take that capital relief, so consequently they're incentivized to just invest in Europe, while the U.S. investor base will remain firmly based in U.S. assets. That creates maybe not a bifurcation, but it certainly fragments, a global market, and we all know markets are global. If you see Basel IOSCO take root, then all investors across the world, except for the U.S. right now, potentially could get this capital relief, meaning that they now can get a higher rate of return on capital by investing in the same product relative to what a U.S. investor might be. That means you're going to see more non-U.S. investors investing in the U.S. economy. I don't think that's a good thing. If you expand to what happens if we see another crisis and another bailout mechanism, what we saw last time was when local governments came in and gave money to their local banks, there was a stipulation attached to a lot of that they could only then re-lend it within that jurisdiction.
So the European Commission created a better regulations task force, and that includes a public call for evidence to review financial regulations and to consider ways to recalibrate rules to support market liquidity, lending, economic expansion. Doesn't make sense then that we do the same?
It makes absolute sense. We've got a lot more to lose considering how liquid our markets are to begin with.
And I would, I'll go back and let Mr. Arena answer that and expound on that other question I'd asked as well about the consequences.
Yes, I mean, there definitely needs to be an alignment between the U.S. and Europe and how they're applying these types of standards. And again, I think it goes to Congressman, just the idea of uncertainty in the marketplace with respect to how regulators generally are treating the capital markets. The capital markets are global. They're not just European or U.S., they're global. There needs to be harmonization between the two.
Thank you very much, Mr. Chairman. I appreciate the time.
Gentleman yields back, and I see we've been joined by a couple others. Gentleman is recognized. Ms. Ellison. Yes, sir.
Let me thank the chairman and ranking member and all the members of the panel. Just a few questions. Section 941 of Dodd-Frank requires that securitizers or originators to retain up to 5% of the credit risk of asset-backed securities. could, directing my question to Mr. Stanley, or Mr. Stanley, could you please describe why Congress and the public determined that it was necessary to retain such risk, and what problem was Congress wanting to address by requiring skin in the game?
Well, fundamentally, what we learned during the financial crisis was that there are grave dangers in the originate to distribute model, because the people who are structuring very complex, very opaque securities are selling them to other people who will take the losses if those securitizations fail to perform. And we saw investors being misled about the quality of the underlying loans in the securitizations. And we also saw a complete failure of the credit rating agencies to properly police this market. And I think reform of the credit rating agencies is another thing we need. But risk retention is designed to align those incentives properly between the sponsor and the investor.
So there's a pending piece of legislation, H.R. 4166. It would allow a CLO manager to only retain about 0.004% or 40 basis points of the credit risk of a qualifying CLO if the CLO meets certain requirements. Is retaining only 40 basis points significant enough to ensure that the CLO manager has an economic interest in the long-term performance of a security?
I don't believe it is, and that's $400,000 in economic risk on a $100 million deal. I don't believe that is adequate. And we also saw that in order to qualify for that level of risk retention, there were no restrictions or rules put on the quality of the underlying loans there. You could lend to a very, very heavily leveraged company, do the equivalent of subprime business lending, and get that exemption.
So how does retaining 40 basis points or 0.004% slice of the credit risk compare to a CLO's manager's other income?
Excuse me, I'm not sure.
Well, I guess the question is, how meaningful is it? I mean, is it a loss that they can bear? So my question is, how does retaining 40 basis point or a 40 basis point slice of the credit risk compare to a CLO manager's other income?
Well, I don't think I think that absolutely would be a loss that they could bear, and potentially the danger that you see is that you could profit more on misleading investors as to the quality of a $100 million deal in terms of the price you would get for that than you stood to lose in terms of the risk that you had retained.
Congressman Nelson, may I put some math around the numbers?
Feel free, yeah.
Certainly. So one of the things that the Dodd-Frank Act said is credit risk retention needs to be 5% of the credit risk of the assets. It does not need to be 5% of the notional amount of a securitization. It's got to be 5% of the credit risk. So one of the things that has been proposed in the qualified CLO is that the CLO manager must retain 5% of the equity. Almost all the credit risk resides in the equity, so therefore, by holding 5% of the 5% of the equity, the manager is holding 5% of the credit risk. When you add the subordinated fees on top of that, which also embed credit risk, they hold more than 5% of the credit risk. That actually conforms with the Dodd-Frank Act.
Do you buy that, Dr. Stanley?
Yeah, I just don't see how we can argue after the experience of the financial crisis that the only credit risk in a securitization is just in that equity slice. When you look at this bill, the CLO is actually allowed to hold 10% of its assets in high-risk loans. They only have to hold, the requirement is that they hold 90% of their assets in senior debt. So that could be 10% of their assets in high-risk business loans. And that 10% itself exceeds the 8% equity tranche. So I just don't really buy the...
Mr. Green, do you have any thoughts on this?
Yeah, no, I would add that the performance of the higher tranches was a problem as a mark-to-market basis during the crisis. And quite frankly, you saw, which is what motivated the conflicts of interest rule by that Carl Levin and the perma-subject investigations highlighted very clearly, and which is somewhat presented in the movie Big Short. That has not been done and completed by the Securities Exchange Commission to date. So there's a lot of things that need to be done, including the final implementation of risk retention, the implementation of the ban on conflicts of interest, and other things.
I'm out of time. Let me thank the panel.
The gentleman's time has expired. Ms. Messer is recognized for 5 minutes.
Thank you, Mr. Chairman. I'm back here. I want to thank all the members of the panel. As a member of who represents 19 rural counties in southeastern and central Indiana, I frequently hear from constituents who are struggling to gain access to capital, loans, and financial products that fit their unique needs. Many of the lenders in my district and financial service providers have expressed concerns to me about the overly burdensome regulations and increased compliance costs, and that they're a major hindrance to their ability to serve customers in my area of the country. And while most everyone agreed that in the wake of the 2008 financial crisis, reform in the financial service sector was necessary, this administration's response with a cocktail of laws and regulations have in effect prevented healthy market competition and caused severe liquidity shortages, as we've discussed today. I want to thank the chairman for calling this hearing to discuss the difficulties these laws and regulations have caused for commercial mortgage-backed security and collateralized loan obligation providers. These providers fill important market demand, especially in my district in Indiana and all across the country. I believe the proper role of the federal government should be to promote consumer choice and encourage competitive markets and provide smart regulation to protect consumers. Of course, that doesn't mean that government should try to regulate all risk out of the market. And so my first question is to Mr. Renna. And you mentioned today in your testimony that as a result of these risk reduction policies, we should see a reduction in overall commercial lending. What effect do you think that will have in tertiary markets or in English, smaller markets like my district in rural Indiana? Do you think we'll start to see those effects even before regulations kick in at the end of the year?
Yes, thank you, Congressman. Those are the markets that are going to suffer first, because what CMBS achieves and the role that it fulfills in commercial real estate lending is to mostly be able to provide financing to secondary and tertiary markets, not major markets themselves. It does this because by accessing the public capital markets, you get an efficiency of borrowing, and that passes through to borrowers who maybe don't have the most pristine credit or their assets have some issues with them. CMBS is intended to apply to those types of properties. And if there's too much restriction on it, or unnecessary restriction, we accept risk retention. It is the law until Congress changes it. Yeah. We're simply just trying to get the regulators to acknowledge the uniqueness of our asset class within the regulatory rules.
And quick follow-up question. Do you believe investors will begin to take their business elsewhere after these regulations kick in, away from commercial mortgage-backed securities?
You know, everything is risk-adjusted return. It's really going to depend on the ability of the lending market to be able to put the product out there for investors. I think the investors will find that it's a solid product, but it's going to be I think the calculus more is what is the entire amount of financing that the lenders will be able to provide.
Yeah, okay. Next question to Ms. Coffey, and again, appreciate your testimony as well. You note in your testimony that more than 1,000 companies employing more than 6 million receive financing from CLOs, securitized corporate debt, many of which, of course, do business in Indiana and in my district, I'm sure almost every other district in the country. Would you elaborate on the effects that rules like the Volcker Rule and others could have on U.S. businesses that rely on asset-backed security markets?
Sure. What I'd like to do is focus on risk retention, because that's very much the challenge today. What the risk retention rule will do is it will dramatically reduce the formation of CLOs going forward. We've already seen that starting in the second half of 2015. Investors required risk retention on CLOs, or the ability to comply, and issuance dropped off very dramatically. What does this mean to companies like those in your district? This means that the $420 billion of financing that CLOs provide to companies like those in your district will no longer be available. What will those companies do? Well, they've got two choices. They can find more expensive sources of financing, like hedge funds, not ideal, or they might not get the financing at all, which would impact jobs, could create downsizing, or at worst case, even bankruptcies.
So you've sort of answered this question, but let me ask you more directly. Will these policies hurt the very people that they're designed to protect?
Absolutely.
Thank you. I have no further questions, Mr. Chairman. Yield back the balance of my time.
The gentleman yields back his time. We go now to Massachusetts. Mr. Capuano is recognized for perhaps the final word.
That's good. I like that.
That's
Thank you, Mr. Chairman.
I know that is a little scary.
I know, it's unusual. I'll make it nice. Mr. Chairman, I just came by briefly. First of all, thank you for your indulgence. I'm not on this subcommittee, and thank you for offering me the opportunity to participate for a minute. I really just came by to say thank you to the chairman and the ranking member for putting what is hopefully a relatively non-controversial bill forward. I consider myself a great defender and a great supporter of Dodd-Frank and all these items that we've discussed today. I think most of my position is pretty clear. However, I never thought that any law was 100% perfect, and I think part of our responsibility is when we do something, if we find a problem with it later on, we should fix it. I actually think 4096 is a relatively simple fix to a relatively simple problem that I don't believe at all will jeopardize anybody. And for those of you who think that it might, I would love to have a discussion with you to see. This is not the place. I actually don't like these hearings because you can't have a discussion. I'd like to hear from you because that's not my intent. My intent is simply to allow business to do something that I don't think we intended to do in the first place. And I want to say, Mr. Chairman, that I think it's, I'm not so sure how I fit into this bipartisanship. It's not comfortable for my role. I'm not used to it, but I'm getting used to it. You know, last year you and I co-sponsored a bill that I really expected like the earth to split in half when you and I co-sponsored a bill, and it didn't happen. I was a little disappointed.
Held together, yeah.
We can hope.
We can do it again.
I hope so. And this year, again, these are small, bullet shots right directly to a problem. And I wanted to, again, thank you for the opportunity to do this. I know it's unusual, not just for me, it's also a little unusual for you. And I wanted to thank you for doing it and look forward to working with you on this and many, many important items in the future.
For years to come. And I thought you were going to be the last word on this.
Damn, Barr came back, huh?
Mr. Barr has returned. Does the gentleman yield back the remaining of his time? Thank you. Mr. Barr?
Thank you, Mr. Chairman. To the witnesses, thanks for your patience. I think I'm at the end of the line here. I want to focus on how the regulator's overbroad application of risk retention requirements will actually destabilize the financial system and how my legislation, H.R. 4166, the Barr-Scott legislation, would actually enhance financial stability. And first, I would reference a letter that I wrote to Chair of the Federal Reserve, Janet Yellen, back last fall, and I asked whether or not she would support the concept of a qualified CLO as included in our legislation, and in part, this is what she wrote back. The board recognizes certain structural features of qualified CLOs may contribute to aligning the interests of CLO managers with investors with respect to quality of securitized loans. In this regard, an increase in the availability of CLOs that reflects strengthened underwriting and compensation standards, among other features, could be considered a positive development in the market. I request unanimous consent to insert this letter into the record. Unanimous.
Without objection.
Thank you. And now I'd like to turn to Ms. Coffey and examine Dr. Stanley's contention that bond issuance has soared, Mr. Green's argument that this is a make-believe liquidity crisis. This contradicts your testimony regarding the 2015 precipitous drop in CLO issuance, and I'd like to give you a chance to respond to that.
Thank you very much, Congressman Barr. As we saw in 2015, the beginning of the year actually went fairly well for CLO formation and hence financing to U.S. companies. By the time we hit the middle of the year, most investors were saying CLO managers needed to be able to show the ability to comply with risk retention, and we saw CLO formation drop 40% from the first half of the year. We saw 30 managers that issued CLOs in 2014 being unable to issue them in 2015.
Yeah, and considering the fact that mortgages were at the epicenter of the crisis and yet enjoy a qualified mortgage safe harbor, it seems to make sense that we should provide an analogous safe harbor, a qualified CLO, to an asset class that, as you've testified to, performed much better during the financial crisis and over a 20-year period. Obviously, it performed well with a negligible default rate. Let me ask you also, Ms. Coffey, to respond to, I think, Dr. Stanley's concern about covenant-light loans, and what does our bill do about covenant-light loans and asset quality?
Certainly. So first of all, one of the things I would like to say about covenant-light loans is our proposal actually has a constraint on covenant-light loans, limiting them to a lower amount than what we see in the market today.
So asset quality would actually be enhanced through this legislation. Now, let's turn to my colleague, Mr. Lynch's concern and Dr. Stanley's concern about the potential that, according to them, that our bill would risk repeating the originate to distribute model that led to the financial crisis. Can you respond to this particular criticism, especially with reference to the fact that CLOs are long-only match-funded, meaning that they issue long-term bonds not marked to market and therefore actually act to stabilize the market?
Absolutely. 2 points. 1, CLOs are not originate to distribute securitizations. 2, CLOs are completely match-funded. They are buyers when other people are sellers, and thus they act to stabilize the market. That is a very important benefit for U.S. companies.
And finally, let's talk about 2018, 19, and 20, and the maturity wall with CLOs. And if we don't fix this problem, what will happen to the financial stability of the corporate credit market out there, particularly when you have, as Moody's says, CLO formation shrinking and corporate refunding requirements expanding, especially through 2020, and the impact that a failure to fix this problem will have on access to credit and the cost of financing for job-producing American companies?
Absolutely. 2019, 2020, there's expected to be $700 billion of refinancing needs. CLOs, as they are currently constituted, have about $100 billion in 2019, about $20 billion of capacity in 2020. If they go away, if there is no more CLO formation, that gap is going to have to either be financed elsewhere, expensively through entities like hedge funds, or companies will not get the financing they need.
And in the remaining time that we have, about 30 seconds, could you talk about the impact that diminution of the CLO market will have on job creation, and then also why a qualified CLO concept enhances the distinction between the residential mortgage-backed securities that were the cause of the financial crisis and what we're describing here in this legislation?
Absolutely. The qualified CLO puts 6 constraints on CLOs that will enhance their quality: asset quality, portfolio diversification, capital structure, alignment of interest, regulation, and transparency and disclosure. By putting that in and requiring the manager to retain 5% of the equity, we meet the rules, we meet the Dodd-Frank rules, and we will have the continuation of CLOs that will provide financing to U.S. companies.
Thank you for testifying.
And I would just add one thing, just from an SFIC perspective. We have investors and issuers in our membership. About 20% of our 350 members are investors. This has support across the board, so the balance of making sure investor and issuer interests is pretty well established.
And if I could add one thing, it's important to distinguish between liquidity and credit. Absolutely, we should make sure that companies have access to credit, but the most important thing to do is that to ensure that credit quality is good. That means the macroeconomy continues to need to grow.
Well, I think it's an indication that we need to be focusing on what the views are of market participants, not just what the New York Fed is saying. Thank you. I yield back.
And with that note, that we're not going to be paying so much attention to the New York Fed going forward. Let me begin by saying thank you again to the entire panel. This was a great panel, and from both sides of the argument here, but very in depth. And I very much appreciate getting into the weeds with this various complicated issue. And I very much appreciate having people like Mr. Barr and Mr. Hill here, who were able to go dive down into it. Certainly with Mr. Hill's background in this area as well. So thank you, Mr. Hill, for your knowledge on this topic and in figuring it out as well. I think one of the takeaways is that this was the highly rated asset-backed securities. I think it was uncontroverted, was not vis-a-vis the other asset classes, was not a cause of the root problem. I think we've heard that from the very beginning to the very end. And I think what we also heard, not unanimity, of course, but strongly from the actual market participants, that we are concerned about, we should be concerned about the impact of Dodd-Frank in this area. So with that being said, I would like to thank all witnesses again. The chair notes that some members may have additional questions for this panel, some who are here, some who are not, which may wish to submit them in writing. And without objection, the hearing record will remain open for 5 legislative days for members to submit their written questions to all the witnesses, and then to place those answers from you into the record. And also, finally, without objection, members have 5 legislative days to submit extraneous materials to the chair for the inclusion in the final record. And with that, and without objection, this hearing is hereby adjourned. Thank you.